Welcome to Audio Mentors, your space to learn and transform your financial life through practical knowledge and effective strategies. On this occasion, we present an exclusive summary of Training Manual, Financial Education, Your Money and Your Future. This book is a comprehensive guide to understanding how to manage your personal finances, from creating a budget to planning for the future, including saving strategies, investment, and financial protection. This summary has been prepared exclusively by us in order to offer you the most valuable tools to take control of your money, grow your wealth, and guarantee a stable financial future. Throughout the chapters, we will explore how to make smart financial decisions, avoid the most common mistakes, and how to educate yourself and your family in proper money management. If you like this content, don't forget to subscribe to Audio Mentors. By doing so, you'll be able to access more audiobooks, summaries, and lessons on financial education, as well as other topics that will help you achieve personal and professional success. Let's start this journey towards financial freedom and building a more solid future. Chapter 1: Introduction to Financial Education. Financial education is much more than a set of technical skills. It is the foundation upon which the ability to make informed and responsible decisions about money is built. In this chapter, we will explore the importance of financial education, how it affects all aspects of our lives, and why it is essential to achieving long-term economic stability and success. Why is financial education important? In a society where economic decisions directly affect our quality of life, having a solid understanding of personal finances is not just a benefit. It is a necessity. Financial education allows us to understand how to manage our money efficiently, how to make decisions that promote our prosperity, and how to protect ourselves from the financial traps that lie in wait throughout our lives. 1. Economic empowerment. One of the greatest benefits of financial education is the economic empowerment it offers. With the right knowledge, people can make wiser decisions about their money, which in turn allows them to have full control over their financial life. This means that you can make informed decisions about how to save, spend, invest, and manage your debts. For example, if you know how to create and stick to a budget, you will be in control of your personal finances, which will reduce stress and give you a sense of security. Financial education also teaches you how to set long-term goals, such as saving for retirement or buying a house, which will allow you to move forward in life with a clear purpose. 2. Reduced financial stress. Stress related to personal finances is one of the main sources of anxiety for many people. Worries about money, debt, and the financial future can affect mental and emotional health. Financial education helps to reduce this stress by providing the tools needed to face these challenges. By learning to manage a budget, save regularly, and plan for the future, you can avoid the financial problems that lead to constant worry. Having an emergency fund, for example, will give you peace of mind knowing that you are prepared to face unforeseen situations, such as job loss or a medical emergency. 3. Preparing for the future. Financial education also plays a crucial role in long-term planning. While day-to-day life may require immediate attention, it is essential to think about the future. As we get older, our financial needs change, and it is essential to be prepared for retirement, our children's education, or even emergencies that may arise along the way. Knowledge about financial products such as pension plans, investment funds, or insurance allows people to make informed decisions and shape a secure financial future. Planning early for retirement or saving for children's education are clear examples of how a solid financial education can ensure that you not only live well today, but also in the future. Impact of financial education on daily life. Financial education is not just theory, it has a direct impact on the everyday decisions we make. From how to spend our money to how to manage credit, each of our financial choices has repercussions in our daily lives. Financial education teaches us to make these choices in an informed way, which helps us avoid costly mistakes and make decisions that bring us closer to our goals. 1. Budgeting as a fundamental tool. One of the first lessons of financial education is how to create a budget. An effective budget is a vital tool for managing personal finances. A budget helps you to prioritize your expenses. It allows you to know what you're spending your money on and adjust it to make sure you are investing in what really matters. A well-structured budget will help you prioritize needs over wants, which is essential to keep your finances balanced. Set clear goals. A budget helps you allocate specific amounts to save, invest, and pay off debts. This way, every month you will have a clear guide on how to manage your money to meet your short and long-term goals. Control spending and avoid debt. By following a budget, you are less likely to fall into the debt trap, as you will be aware of how much you can spend and how much you should save. It is a control tool that helps you avoid impulsive spending. 2. Saving and investing as the basis of financial well-being. Financial education also highlights the importance of saving and investing. Saving provides you with a safety net in case of unforeseen events and allows you to plan for the future. However, saving alone is not enough to achieve financial independence. This is where investing comes in. Savings. Although it does not generate high returns in the short term, saving is essential to cover emergencies and immediate goals. By learning to save a percentage of your income, you create a financial base that will protect you against unforeseen events, such as car repairs, medical emergencies, or the temporary loss of income. Investment. Investment is what allows you to grow your money over time. Whether through stocks, bonds, mutual funds, or real estate, investment is key to long-term wealth creation. Without proper financial education, it is easy to make wrong decisions when investing, which can result in significant financial losses. 3. Credit and debt management. Credit is a powerful tool, but it must be managed with caution. Many people fall into the trap of over-indebtedness, which prevents them from achieving their financial goals. Financial education teaches you how to use credit responsibly and how to avoid the dangers of debt. Responsible credit. Understanding how credit cards and personal loans work will enable you to use them effectively. Knowing when to take out a loan, how to choose the best conditions, and how to pay on time are key skills that will help you keep your credit history intact. Debt. Managing debt is one of the most important aspects of financial literacy. It is crucial to understand the types of debt, interest rates, and the consequences of not paying on time. With a proper payment plan, you can reduce and eliminate debt, freeing up resources for saving and investing. Financial education as a habit. Financial education is not something that is learned once, but must be cultivated and practiced throughout life. It is a continuous process of learning and adapting to life's changing circumstances. Everyday lessons. Financial education should be part of everyday decisions, such as choosing where to live, how to spend your money, how to save for the future, and how to protect your assets. Making informed decisions, although it can sometimes seem overwhelming, becomes easier with practice. Constant education. As the financial environment changes, it is important to keep learning. This includes staying informed about new financial products, investment strategies, and changes in tax laws that may affect your financial situation. Conclusion. Financial education is a vital tool for achieving economic stability, reducing money-related stress, and reaching long-term goals. It allows you to take control of your finances and make responsible decisions that will contribute to your economic and personal well-being. Throughout this book, we will learn how to apply these principles to real situations and how to use them to improve our lives and achieve our financial goals. In the next chapter, Financial Planning, the first step to stability, we will take a closer look at how to create a long-term financial plan that will help you achieve financial stability, set clear goals, and successfully achieve your financial objectives. Chapter 2, Financial Planning, the first step to stability. In this chapter, we will delve into financial planning, a fundamental step towards achieving long-term financial stability. Financial planning not only involves knowing how much to spend and how much to save, but also establishing a structured plan to achieve specific financial goals. Through proper planning, you can have a clear vision of the future and ensure that your current financial decisions are aligned with your long-term goals. Why is financial planning important? Financial planning is essential to take control of your personal finances and to prevent impulsive financial decisions from diverting you from your goals. Without proper planning, it is easy to fall into the trap of living day to day, spending more than you earn, or not preparing for the future. Financial planning allows you to organize your income, expenses, savings, and investments strategically to achieve a stable financial life. 1. Setting clear financial goals. The first step to effective financial planning is to set clear goals. Financial goals can range from setting up an emergency fund to buying a house, educating your children, or planning for retirement. Having specific and measurable goals allows you to have a clear purpose and a plan to achieve it. Short-term goals. These are goals that you can achieve within 1 to 3 years. Examples of short-term goals include saving for a vacation, paying off credit card debt, or creating an emergency fund. Medium-term goals. These are goals that are achieved within 3 to 5 years. For example, saving for a down payment on a house or financing a child's college education. Long-term goals. These are goals that will take more than 5 years to achieve, such as saving for retirement or building significant wealth through investments. Planning for retirement is a key goal in this category. When defining your goals, make sure they are specific, measurable, achievable, relevant, and time-bound. This will allow you to have a clear focus and know what actions to take to achieve them. 2. The budget, a key tool in financial planning. The budget is the basis of any financial plan. It is a tool that helps you visualize and control your monthly income and expenses, allowing you to live within your means and save for your goals. Through a well-structured budget, you can ensure that your expenses do not exceed your income and that you have enough money to save and invest. Determine your income. Make a list of all your sources of income each month, whether it's a fixed salary, freelance income, passive income, among others. Classify your expenses. Divide your expenses into 2 categories. Fixed expenses, those that do not change from month to month, such as rent, mortgage, utilities, etc., and variable expenses, those that vary, such as entertainment, personal shopping, food, etc. Save first. A fundamental rule of financial planning is pay yourself first. This means that before spending money on anything, make sure you set aside a portion of your income for saving and investing. The general recommendation is to save at least 20% of your income. Monitor and adjust your budget. Review your budget regularly to make sure you're still on track. If you find that you're spending more than planned in any category, make adjustments to maintain balance. 3. Controlling debt and unnecessary expenses. Controlling debts and unnecessary expenses is a fundamental part of financial planning. Accumulating debts can undermine your ability to save and invest, so it is crucial to establish a plan to pay off debts and avoid incurring new ones. Prioritize debt repayment. If you have several debts, it is important to prioritize the repayment of those with the highest interest rates, such as credit cards. The faster you pay off these debts, the less you will pay in interest in the long run. Avoid easy credit. Credit is not always the solution for large purchases. If you can't pay for something with cash, reconsider whether you really need it. Using credit without control can lead to over-indebtedness that is difficult to manage. Review your monthly expenses. Identifying and reducing unnecessary expenses is an effective way to improve your financial situation. Do you really need all those streaming subscriptions? Can you cut back on your restaurant or entertainment expenses? Cut back on non-essentials and redirect those funds towards savings. 4. Savings and investment. Building wealth. Financial planning is not just about making a budget and paying off debts, it's also about saving and investing for the future. Saving provides you with a safety net and the money you need to achieve your short-term goals. Investing, on the other hand, allows you to grow your money in the long term, helping you to achieve bigger goals such as retirement or buying a house. Emergency savings. The first thing you should do when you start saving is to create an emergency fund. This fund should cover 3 to 6 months of your essential expenses and will help you deal with unforeseen events without resorting to credit or loans. Long-term investments. Once you have an emergency fund, start investing for the future. Long-term investments, such as mutual funds, stocks, and real estate, will allow you to grow your money over time. When investing, it is important to diversify your assets to reduce risk and take advantage of the growth of various markets. Retirement. Planning for retirement should be a priority. The earlier you start saving and investing for your retirement, the more time you'll have to accumulate funds and take advantage of compound interest. Contributing regularly to a retirement account, such as a 401k or an IRA, is an effective way to secure your financial future. 5. The importance of reviewing and adjusting your financial plan. Life is full of changes, and your financial plan should be flexible enough to adapt to them. Whether it's a change in your income, your family situation, or your goals, it's important to review and adjust your financial plan regularly. Review your plan annually. As you progress towards your financial goals, review your plan annually and adjust your budget, savings, and investments if necessary. This will allow you to stay focused on your goals and adapt to new circumstances. Adjust as needed. If you experience an increase in income, adjust your savings and investment plan to take advantage of it. If you have a decrease in income, review your expenses and look for areas where you can cut back to maintain balance. Conclusion: financial planning is one of the most important skills you can develop to ensure your long-term financial stability. Creating a clear plan, setting achievable goals, and keeping track of your finances will enable you to take control of your future. By starting with a solid budget, saving and investing for the future, and controlling your debts, you'll be on the road to a successful financial life. In the next chapter, The Family Budget, Controlling Income and Expenses, we will delve deeper into how to create and manage an effective family budget to ensure that each member of your household participates in the process and contributes to the family's financial health. Chapter 3: The Family Budget, Controlling Income and Expenses. In this chapter, we will delve deeper into the creation and management of an effective family budget. The budget is one of the most powerful tools for achieving financial stability, and its importance is amplified when applied in the context of the whole family. Properly controlling income and expenses not only ensures that daily needs are met, but also allows for planning for the future, achieving shared goals, and avoiding financial stress. Why is a family budget important? A well-structured family budget is essential for achieving economic stability, especially in households where there are multiple sources of income and a variety of expenses. Having a clear budget and following it regularly allows all family members to be aligned with financial goals and prevents impulsive decisions that could compromise financial health. 1. Expense control. A family budget helps to monitor expenses and prevent the accumulation of unnecessary debt. By being clear about where the money goes, it is easier to make decisions about what to spend on and what not to spend on. 2. Saving for the future. A well-designed budget includes saving as a priority. Whether for emergencies, children's education, or retirement, saving becomes much easier and more effective when a fixed percentage of monthly income is allocated. 3. Informed decision-making. Having a budget allows you to make informed decisions about how to allocate family resources. Whether it's planning a vacation, buying property, or making an investment, a budget provides the clarity you need to make decisions with confidence. 4. It ensures that all members are on the same page. A family budget encourages collaboration among household members. Everyone must be committed to the common goal of keeping family finances under control, which includes discussing financial priorities and making joint decisions. How to create an effective family budget. 1. Identification of family income. The first step in creating a family budget is to identify all sources of income within the household. This includes not only salaries, but also any additional income such as income from secondary jobs, rents, passive income, etc. Having a complete picture of available income will allow you to set a realistic budget. Main income. The salaries of family members who have stable jobs. Make sure you include net income, i.e. after taxes and deductions. Additional income. Any extra income, such as freelance, sales, investments, or rental income. These can be more variable, so it is important to consider a realistic range. 2. Classifying and prioritizing expenses. The next step is to identify and classify all the family's expenses. There are two main types of expenses: fixed expenses and variable expenses. Fixed expenses are those that do not change from month to month, such as rent or utility bills, while variable expenses are those that can fluctuate, such as food, entertainment, and personal purchases. Fixed expenses. These are expenses that you have to cover every month, and they don't vary much. They include rent or mortgage, utilities, water, electricity, gas, internet, insurance, health, car, home, loans and fixed debts, payment of personal loans, credit cards, etc. Variable expenses. These are expenses that can vary from month to month. Some examples include food, supermarket, restaurants, transportation, gasoline, public transportation, vehicle maintenance, entertainment, outings, streaming subscriptions, recreational activities, clothing, gadgets, and other non-essential expenses. Tip: review the last 3 months of your financial statements to get a clear picture of how much you spend each month. This will help you identify patterns and areas where you can cut back. 3. Allocate a fixed amount for savings. Savings should be a priority in any family budget. Ideally, set aside a fixed percentage of monthly income for savings, even if it seems difficult at first. This can include emergency fund, a fund that covers between 3 and 6 months of essential expenses for unforeseen situations, such as job loss or unexpected medical expenses. Savings for long-term goals. This includes children's education, buying a home, or retirement. Savings for personal goals. In addition to long-term goals, you can include savings for personal projects, such as travel, home renovations, etc. 4. Debt review. A fundamental part of family financial planning is evaluating debts. Make sure the budget includes a plan to pay off debts, starting with the highest interest debts, such as credit cards. The goal is to reduce the debt load as quickly as possible to free up more resources for saving and investing. Short-term debts, credit card debts, personal loans, and any other debts that have high interest rates. Long-term debts, mortgages, student loans, car loans, among others. For each type of debt, establish a payment strategy. It can be the snowball strategy, paying off smaller debts first, or the avalanche strategy, paying off debts with the highest interest rates first. 5. Regular monitoring and adjustments. A budget is not fixed. It should be adjusted as your income and expenses change. If your income is higher in any given month, you can increase your savings or allocate more money to paying off debt. On the other hand, if your income decreases, it is important to adjust your variable expenses to adapt to the new situation without compromising your savings or basic needs. Monthly review. Review your budget at the end of each month. This will allow you to see if you have really followed the plan and if it is necessary to make adjustments. If your variable expenses increase, cut back in other areas. Family discussion. Make sure that all family members are aware of financial decisions and participate in discussions. This encourages commitment and shared responsibility in the management of finances. Tools for a successful family budget. There are several tools that can make it easier to create and monitor your family budget. 1. Mobile apps and finance software. There are many apps and programs that allow you to keep track of your income and expenses, such as Mint, Inab, You Need a Budget, or Pocket Guard. These tools allow you to automate the process and receive alerts when you approach your spending limits. 2. Spreadsheets. If you prefer a more personalized approach, you can use programs like Excel or Google Sheets to create your own budget. Spreadsheets allow you to organize and categorize income and expenses in a flexible way. 3. Cash control envelopes. A more traditional but effective approach is to use envelopes to divide the money allocated to different categories of expenditure. This method helps you avoid spending more than you have available. Conclusion. The family budget is a powerful tool for managing income and expenses efficiently, guaranteeing economic stability in the short and long term. Creating an effective budget, setting clear goals, and following it in a disciplined way will allow you to have greater control over your finances, reduce money-related stress, and achieve the goals you have set for your family. In the next chapter, Setting Financial Goals, the foundation of planning, we will take a closer look at how to set clear and achievable goals, both for the family and for individuals, to ensure that each member is focused on a common goal of financial growth and security. Chapter 4. Setting Financial Goals, the foundation of planning. In this chapter, we will focus on the importance of setting clear and achievable financial goals, which is fundamental to any effective financial plan. Without well-defined goals, it is easy to lose focus and make impulsive financial decisions that do not bring you closer to your long-term goals. Financial goals act as a map that guides you, allowing you to focus your efforts and resources on what really matters. Why are financial goals important? Financial goals provide direction and purpose to your economic life. They motivate us to save, to reduce debt, and to make more informed decisions, as we have a clear vision of what we want to achieve. Without goals, it is easy to fall into the trap of impulsive consumption or to live in a disorganized way, which can affect your financial stability. 1. Long-term orientation. Financial goals are not just for the present. They also help us plan for the future. Whether it's for retirement, children's education, or buying a home, long-term goals motivate you to think beyond immediate needs and make decisions that will ensure a secure future. 2. Focus and discipline. Setting clear goals allows your money to work in the right direction. By having specific objectives, you can structure your budget, savings, and investments in line with those goals. This encourages financial discipline and prevents you from deviating from your plan. 3. Measuring progress. Financial goals allow you to measure your progress over time. With specific and measurable goals, you can assess how close you are to achieving them and adjust your strategy if necessary. This also helps you celebrate important achievements, which reinforces your motivation. Types of financial goals. There are different types of financial goals that vary according to their time horizon and their impact on your finances. It is important that each of these goals is clearly defined so that you can direct your efforts and resources effectively. 1. Short-term goals, less than 1 year. These are goals that you can achieve within a year. Generally, they are small but important objectives that allow you to improve your immediate financial situation. Examples of short-term goals. Pay off a small debt. Pay off the balance on a credit card or a personal loan. Create an emergency fund. Save between $500 and $1,000 to cover unexpected expenses. Save for a vacation. Plan and save for a family vacation without resorting to credit. How to achieve them. Track your progress each month. Review your budget to make sure you are saving consistently. Set aside a percentage of your income. Dedicate a fixed percentage of your monthly income to savings or debt repayment. 2. Medium-term goals, 1 to 5 years. Medium-term goals take longer to achieve, but are attainable if you work steadily towards them. These goals involve larger financial decisions that have a long-term impact, such as buying a house or paying off a significant debt. Examples of medium-term goals. Buying a house. Saving for a down payment. Saving for your children's college education. Create a specific fund for future education. Paying off long-term debts. Pay off larger loans, such as a car loan or student loans. How to achieve them. Save consistently. Dedicate a fixed amount of money to your savings fund every month. Research financing options. If your goal is to buy a house, research different financing options and interest rates and choose the one that best suits your situation. 3. Long-term goals, more than 5 years. Long-term goals are those that involve planning and discipline over many years. These goals are often larger and more complex, but they are essential to ensure a stable financial future. Long-term goals often include objectives such as retirement, wealth creation, and financial independence. Examples of long-term goals. Saving for retirement. Ensuring you have enough money to live comfortably after you stop working. Creating a nest egg for financial independence. Saving and investing to generate passive income and live without relying on a salary. Investing in real estate or your own business. Building an investment portfolio that grows and generates income over the long term. How to achieve them. Constant investment. Allocate a portion of your monthly income to investments that will grow over time, such as investment funds, stocks, or real estate. Take advantage of compound interest. The sooner you start saving and investing, the more time your money will have to grow thanks to compound interest. How to set smart financial goals. For your goals to be effective, they must be smart, that is, specific, measurable, achievable, relevant, and time-bound. This methodology will help you create clear goals that you can monitor and achieve successfully. Specific. Define exactly what you want to achieve. Instead of saying, I want to save money, say, I want to save $5,000 for an emergency fund in the next 6 months. Measurable. Make sure you can measure your progress. If your goal is to save for a purchase, determine how much money you need and how long it will take you to achieve it. Achievable. Goals should be realistic. Make sure your goal is achievable within your circumstances and resources. Setting overly ambitious goals can lead to frustration. Relevant. Your goals should be important to you. Set goals that really align with your values and life goals. Define time. Set a deadline for achieving your goal. This will help you stay focused and will give you a sense of urgency and motivation. How to make an action plan for your goals. Once you have set your financial goals, the next step is to create a clear action plan to achieve them. Here are some practical steps. 1. Break them down into small steps. Long-term goals can seem overwhelming, but if you break them down into small, achievable steps, they will become more manageable. 2. Allocate a fixed amount of money each month. Whether it's for savings, debt repayment, or investment, allocating a fixed amount each month will help you stay focused on your goals. 3. Review and adjust regularly. Review your progress every month or quarter to make sure you're on the right track. If something isn't working, adjust your strategy. Tips to stay motivated. 1. Celebrate small achievements. Every time you reach a small milestone on the way to your goals, take a moment to celebrate. This reinforces motivation and keeps you focused. 2. Visualize your success. Imagine how you will feel when you reach your goal. This can be a great motivator to maintain discipline and keep going. 3. Involve your family. If you have family financial goals, make sure that all members are committed and understand the objective. This generates support and shared responsibility. Conclusion. Setting clear financial goals is an essential step in ensuring your financial success. By having defined objectives, you can make more informed decisions, stay motivated, and ensure that you're moving towards a stable and prosperous financial future. Whether you are saving for a house, investing for retirement, or creating an emergency fund, having a well-structured plan will help you take control of your finances and achieve your dreams. In the next chapter, Saving, the pillar of financial security, we will explore the importance of saving and how to start saving, even with limited resources, to build a solid financial foundation. Chapter 5, Saving, the pillar of financial security. In this chapter, we will delve into one of the most fundamental concepts of financial education, saving. Although it seems like one of the simplest actions, many people have difficulty saving effectively. Saving is not only crucial for dealing with the unexpected, but also for achieving our long-term financial goals, such as buying a house, educating our children, or retiring. Here, you will learn why saving is the pillar of financial security and how to develop the habit of saving consistently. Why is saving so important? Saving is the foundation on which we build solid financial security. Without a proper saving strategy, any unforeseen event or emergency can put our economic stability at risk. In addition, saving allows us to take advantage of investment opportunities and fulfill our life goals. 1. Protect yourself against emergencies. Life is full of the unexpected. From an unexpected illness to urgent repairs to the house or car, emergencies can put our finances to the test. Having an adequate emergency fund gives us peace of mind knowing that, no matter what happens, we can deal with these situations without getting into debt. 2. Avoid over-indebtedness. Saving also helps us avoid resorting to credit to cover unexpected expenses. Excessive use of credit cards or loans can lead to over-indebtedness, which puts our financial stability at risk. Saving is the safest way to reduce dependence on credit. 3. Achieve personal and financial goals. Whether you want to buy a house, travel, or start a business, saving provides you with the resources you need to meet those goals. Throughout this chapter, we will explore how to set clear and realistic savings goals. 4. Planning for retirement. Saving is not only for dealing with immediate situations, it is also essential for retirement. Starting to save and invest for the future from an early age ensures that you can live comfortably when you decide to stop working, without relying entirely on government benefits or other resources. Types of savings. There are different types of savings, and each one has its purpose. It is important to understand them in order to know how to allocate your money effectively. 1. Emergency fund. The emergency fund is the first type of savings you should build. This fund protects you from unforeseen situations, such as job loss, medical emergencies, or unexpected home repairs. The general recommendation is to save between 3 and 6 months of essential expenses. How to build it? Determine your essential monthly expenses. This includes rent, utilities, food, transportation, and any other necessary expenses. Start with a small goal. If you don't have an emergency fund, start with a goal of $500 or $1,000 and increase the amount as you can. Make regular contributions. Allocate a fixed amount each month, even if it is small, until you have reached your goal. 2. Saving for short-term goals. Saving for short-term goals allows you to plan and finance your immediate objectives. This may include saving for vacation, buying a car, or even home repairs. How to save for short-term goals. Define your goal clearly. How much do you need to save and in what time frame? If you want a $2,000 vacation in a year, you'll need to save approximately $167 each month. Set aside the funds. Consider opening a separate savings account just for these goals. This will help you avoid mixing up your emergency money with the money set aside for specific objectives. 3. Saving for long-term goals. Long-term goals include objectives such as buying a house, your children's university education, or retirement. These require more disciplined saving and a long-term strategy. How to save for long-term goals. Open specialized savings accounts. Retirement savings accounts, such as a 401k or IRA plan, are options that offer tax advantages. Set aside a percentage of your income. To save for the long term, allocate a fixed percentage of your income to your long-term goals. For example, if you plan to save for retirement, start saving 10% of your salary. Invest to grow your money. Saving alone is not enough to achieve big goals like retirement. Investing is the engine that can make your money grow. As you save, invest wisely in stocks, bonds, or mutual funds to increase your purchasing power over time. Strategies for developing the habit of saving. Consistent saving requires discipline, but with the right strategies, you can develop this habit and secure your financial future. Here are some ways to do it. 1. Pay yourself first. This is a fundamental rule for developing the habit of saving. Before spending on anything, set aside a portion of your income for savings. This ensures that saving is not last on your list of priorities, but first. 2. Automate your savings. Automation is a great way to make sure you are saving every month. Set up automatic transfers to your savings or investment accounts right after you receive your paycheck. This removes the temptation to spend that money and helps you maintain the habit of saving effortlessly. 3. Start with a small amount and increase gradually. If you can't save much at first, don't worry. Start with a small amount that you can afford, even if it's only 1% of your income. Then gradually increase the amount as your income grows or your financial situation improves. 4. Keep track of your savings. Keep track of your progress to stay motivated. Use apps or spreadsheets to see how your emergency fund or retirement account grows over time. Every time you see the results of your efforts, you'll feel more motivated to keep saving. 5. Cut back on unnecessary expenses. One of the most effective ways to increase your savings is to cut down on unnecessary expenses. Review your spending habits and make adjustments. Ask yourself, do I really need that extra streaming subscription? Can I reduce my spending on restaurants or entertainment? The money saved in these areas can go directly into your savings fund. Savings and investment. How to make your money grow. Saving is a good start, but investment is what really allows your money to grow over time. As you increase your ability to save, it is essential to consider investment opportunities to make the most of your resources. Diversification. Investing in different types of assets, stocks, bonds, real estate, helps reduce risk and ensures that your investments grow in the long term. Compound interest. Compound interest is one of the most powerful principles of investing. The earlier you start investing, the more time your money has to grow. The profits from your investments are reinvested, generating even more profits over time. Conclusion. Saving is the pillar on which we build our financial security. Starting to save today is essential to face the unexpected and achieve our goals, whether in the short, medium, or long term. With the right strategies, such as automating your savings, saving consistently, and reducing unnecessary expenses, you can build a solid financial foundation for the future. Don't forget that investing also plays a crucial role in growing your savings, helping you to ensure a more prosperous financial future. In the next chapter, Financial Services, Knowing the Options, we will explore the different financial services available, how to choose the best ones for your needs, and how to take advantage of them to maximize your financial well-being. Chapter 6: Financial Services: Knowing the Options. In this chapter, we will explore the different financial services available, their importance, and how to choose the ones that best suit your needs. The variety of options can be overwhelming, but a good understanding of how they work will allow you to make informed decisions that strengthen your financial situation and help you achieve your financial goals. Throughout this chapter, you will learn about bank accounts, insurance, loans, investments, among others, and how to use them strategically to improve your financial well-being. Why is it important to know about financial services? The financial market is full of products and services that can seem complicated, but having a good knowledge of them can give you significant advantages. Knowing what financial products exist, how they work, and which is right for your situation is essential to effectively manage your resources, save and invest intelligently, and protect your assets. 1. Access to suitable financial products. Everyone has different financial needs and objectives. By learning about financial services, you can choose the ones that best suit your situation and maximize the benefits of each one. Whether you need a savings account, insurance, a loan, or an investment fund, knowing the options available will help you make smarter decisions. 2. Better management of your finances. Understanding how financial products and related services work will allow you to manage your money more efficiently. It's not just about saving, but about knowing where to put that money so that it grows and how to protect yourself from risks. 3. Protection of your assets. Financial services also include products designed to protect your assets, such as life, health, and property insurance. Having a financial protection strategy is essential to ensure that you do not lose your assets and that your family is protected in the event of any eventuality. Types of financial services. There is a wide range of financial services, and each one has a specific purpose. Below is an overview of the most important ones. 1. Bank accounts. Bank accounts are one of the most basic, yet essential, financial tools. There are different types of accounts that help you manage your money effectively. Savings accounts. Savings accounts are ideal for depositing money safely and earning a small interest rate. Although they won't generate large returns, they are useful for creating an emergency fund or saving for short-term goals. Checking accounts. Checking accounts are ideal for managing your daily expenses. Unlike savings accounts, checking accounts do not generate interest, but they allow you to make deposits and withdrawals easily and quickly, as well as pay your bills and make transfers. Investment accounts. If your goal is to invest your money, investment accounts, such as mutual fund or stock accounts, allow you to put your money to work in the financial market. These accounts tend to generate higher returns, but carry greater risk. Tip: before opening a bank account, compare the interest rates, fees, and additional benefits offered by different financial institutions. Be sure to choose one that fits your needs and goals. 2. Credits and loans. Credits and loans are financial services that allow you to access money when you need it, with a commitment to repay it within a certain period of time, usually with interest. However, improper use of these services can lead to over-indebtedness. Personal loans. Personal loans are a common option when you need money for a specific purpose, such as buying a car, medical expenses, or home improvements. They usually have fixed interest rates and a fixed repayment period. Credit cards. Credit cards allow you to make purchases on credit up to a certain limit. You should be careful with the interest rates, because if you don't pay the full balance each month, the debts can grow quickly. Mortgage loans. If you are thinking of buying a house, a mortgage loan is the most common. These loans have long terms and generally lower interest rates than other types of credit. However, it is also important to consider additional costs such as taxes, insurance, and administrative fees. Tip: make sure you understand the terms of the credit or loan before signing any contract. Carefully read the interest rates, late fees, and payment terms. 3. Insurance. Insurance is a financial product designed to protect you against certain financial risks. Insurance is essential to safeguard your assets, such as your home, vehicle, health, and life. Life insurance. Life insurance provides financial protection for your family in the event of your death. Depending on the type of insurance, it can offer a fixed amount of money to your beneficiaries to cover funeral expenses, debts, and other outstanding expenses. Health insurance. Health insurance is essential to cover unforeseen medical expenses, such as doctor's visits, hospitalization, and treatments. Depending on the policy, it can cover a wide range of medical services, from general consultations to surgical procedures. Property insurance. This type of insurance covers damage to your property, such as your house or car, in the event of accidents, theft, or natural disasters. It is important to review the coverage and exclusions to make sure you are adequately protected. Tip: assess your needs before taking out insurance. It is important to have the right insurance, but not to overspend on coverage you don't need. 4. Investments. Investments are a key way to make your money grow. There are different types of financial investment products, each with its own level of risk and return. Here we explore some of the most common. Shares. Shares represent a stake in a company. Investing in shares gives you the opportunity to benefit from the company's returns through dividends and share value increases. Bonds. Bonds are debt instruments issued by governments or companies. When you buy a bond, you lend money to an entity in exchange for interest payments. Bonds tend to be less risky than stocks, but they also offer a lower return. Mutual funds. Mutual funds pool the money of several investors and invest it in a variety of assets, such as stocks, bonds, or real estate. Mutual funds allow you to diversify your portfolio, which reduces investment risk. Tip: diversifying your investments is crucial to minimizing risk. Don't put all your resources into a single type of asset. Instead, spread them across several options to achieve a balance between risk and return. How to choose the right financial services. Choosing the right financial services depends on your personal situation and your goals. Here are some tips for choosing the right products. 1. Assess your financial needs. Before making any financial decisions, think about what you really need. Are you looking for a way to save for emergencies? Do you need a loan to buy a house? Are you looking to invest for the long term? Once you know what you need, it will be easier to select the right product. 2. Compare options. Don't settle for the first offer you find. Compare different options in terms of interest rates, fees, benefits, and features. Use online financial calculators to help you make an informed decision. 3. Consult with a financial advisor. If you have questions about which financial products to choose or how to manage them, a financial advisor can provide professional guidance. They can help you create a personalized financial plan that fits your needs. Conclusion: knowing the financial services available and how to choose the most appropriate ones for your situation is crucial to achieving economic stability. From bank accounts to investments, each product has a specific purpose and can help you meet your financial goals. By choosing wisely, you can optimize your resources, protect your wealth, and grow your money in the long term. In the next chapter, Credit and Loans, Uses and Risks, we will explore how to use credit and loans responsibly, what types exist, and the risks associated with indebtedness to help you make informed decisions and avoid falling into the debt trap. Chapter 7. Credit and Loans, Uses and Risks. In this chapter, we will delve into the world of credit and loans, two of the most common financial services which, when handled correctly, can be powerful tools for achieving your goals. However, the improper or irresponsible use of these financial instruments can lead to over-indebtedness and poor financial health. This chapter will help you understand the differences between the various types of credit and loans, when it is appropriate to resort to them, and what risks they entail. What are credits and loans? Credits and loans are a form of financing that allows you to access a sum of money today with the commitment to repay it, usually with interest, within a certain period of time. There are different types of credits and loans, each with its own characteristics and conditions. The key to using them effectively is to understand how they work and when it is appropriate to use them. Types of credits and loans. 1. Personal loans. Personal loans are credits that are granted to individuals to be used according to their needs, whether it be to purchase goods, pay off debts, or make renovations. They are characterized by having a fixed amount, a fixed term, and an interest rate that can be fixed or variable. Advantages: flexibility in the use of the money, fixed or predictable interest rates, relatively quick and easy application process. Risks: if not paid on time, interest rates can quickly accumulate. Failure to make payments can affect your credit history. 2. Revolving credit or lines of credit. Credit lines or revolving credit are a form of financing in which you are granted a credit line up to a certain limit, and you only pay for what you use. These credits usually have variable interest rates, and the amount you pay each month depends on the outstanding balance. Advantages: total flexibility. You can borrow only what you need and pay it back within a specified period, as long as you make the minimum payments. Risks: high interest rates if the balance is not paid quickly. The temptation to spend more than you can easily afford, which can lead to over-indebtedness. 3. Consumer credit. Consumer credit is designed for the purchase of consumer goods, such as electrical appliances, furniture, or electronic devices. It can be granted by banks, shops, or financial institutions, and generally has higher interest rates than personal loans. Advantages: it allows you to make purchases without having to wait until you have the money in full. Payments are usually fixed, and the duration of the loan is limited. Risks: interest rates can increase considerably if the loan is not paid in full within the agreed period. If the loan is used for things that do not increase in value, such as clothing or technology, it can be a bad financial strategy. 4. Mortgage loans. Mortgage loans are long-term loans used to finance the purchase of a property. These loans generally have lower interest rates because the property purchased acts as collateral. Advantages: lower interest rates compared to other types of loans. Possibility of acquiring a property without having to pay the full amount immediately. Risks: the loan is secured by the property, which means that if you default on the payments, you could lose the property. Long-term payments can be high, which could put pressure on your cash flow. 5. Student loans. Student loans are credits that are granted to finance university or technical studies. They usually have special conditions, such as low interest rates and grace periods until the student graduates. Advantages: lower interest rates than personal loans. Grace periods that allow students to start working before starting to pay back the loan. Risks: if the loan is not paid on time, it can affect your credit history. Repayment can be a challenge if you do not get a well-paid job immediately after graduation. When should you resort to credits and loans? Credits and loans should be used with caution and only when necessary. Here are some situations in which it is appropriate to consider resorting to them. 1. Buying important or necessary goods. If you are buying a house, a car, or paying for education, these are important, long-term expenses, so taking out a loan or credit can be a wise decision. Make sure the loan is affordable and the payments fit your budget. 2. Debt consolidation. If you have multiple debts with high interest rates, you could consider taking out a personal loan to consolidate them into a single debt with a lower interest rate. This makes it easier to pay and prevents debts from accumulating. 3. Financial emergencies. In cases of medical emergencies, urgent home or car repairs, a loan or credit may be necessary to cover these unforeseen expenses. However, make sure you can repay the loan in a timely manner. 4. Investing in your future. Taking out a loan to finance further education or start a business can be an investment in your future, as long as it is a viable opportunity and you have a clear plan to repay the debt. The risks of credit and loans. Although credit and loans can be useful, they also involve risks that should not be taken lightly. The main risk is over-indebtedness, which can arise if you do not manage your payments properly or if you cannot meet your obligations when they are due. High interest rates. Some loans and credit, such as credit cards or payday loans, have very high interest rates. If you can't pay the balance on time, the interest can quickly add up. Damage to credit history. Failure to make loan repayments can affect your credit history, making it difficult to obtain future credit or loans. Difficulty getting out of debt. If not managed well, credit and loans can become a burden that is difficult to repay. This can affect your ability to save, invest, or meet your daily needs. Strategies for using credit responsibly. 1. Only borrow what you can afford. Before taking out a loan or using a line of credit, make sure you can afford the monthly repayments without compromising your other financial needs. If the monthly repayment is too high, the loan may not be right for you. 2. Make sure you understand the terms and conditions. Always review the interest rates, term, and conditions of the loan before committing. Don't sign anything without fully understanding what you're agreeing to. 3. Establish a clear payment plan. If you decide to take out a loan or use credit, establish a clear payment plan. Make sure you make your payments on time to avoid late fees and damage to your credit history. 4. Consider alternatives before resorting to credit. If you can, avoid using credit for purchases that are not absolutely necessary. Instead of borrowing, consider whether you can save for the purchase or if there is some other less expensive alternative. Conclusion: credits and loans are valuable financial tools, but they must be used responsibly. It is important to understand the different types of credit, when to use them, and how to manage payments to avoid falling into the debt trap. Proper use of credits and loans can help you achieve your goals, but mismanagement can lead to long-term financial difficulties. In the next chapter, Credit Management, Avoiding Over-Indebtedness, we will explore how to manage credit effectively, how to avoid over-indebtedness, and best practices for maintaining your financial health while using these tools. Chapter 8. Credit Management, Avoiding Over-Indebtedness. In this chapter, we will explore how to effectively manage credit and how to avoid falling into the trap of over-indebtedness. Credit, when used correctly, can be a powerful tool for achieving important financial goals, such as buying a house, financing education, or starting a business. However, mismanagement of credit can lead to a vicious circle of debts that are difficult to control. Throughout this chapter, you will learn the best practices for using credit responsibly and how to avoid the risks associated with over-indebtedness. What is over-indebtedness? Over-indebtedness occurs when the amount of debt you have is greater than your ability to repay it. This can happen when you accumulate too many loans, credit cards, or personal loans, and you don't have enough income to cover the monthly payments. Over-indebtedness can have serious consequences, such as affecting your credit score, causing financial stress, and making it difficult to achieve long-term goals. The risks of over-indebtedness. Over-indebtedness can have negative effects on various aspects of your financial and emotional life. Some of the main risks are described below. 1. Impact on credit history. One of the biggest risks of not being able to pay your debts is the damage it can cause to your credit history. Defaulting on payments can lower your credit score, making it more difficult to obtain loans in the future, even for important needs such as buying a house or a car. 2. High interest rates. When you don't pay on time, interest rates on debts tend to increase. This means you will have to pay more in interest, which lengthens the time needed to pay off the debt and increases the total cost of borrowing. 3. Stress and emotional pressure. Not being able to pay your debts can generate high levels of stress and anxiety. The fear of being unable to cover your monthly obligations can affect your emotional well-being, which in turn can affect your health and quality of life. 4. Limitation on future opportunities. Over-indebtedness can prevent you from accessing new lines of credit or loans. This limits your ability to deal with emergencies or take advantage of opportunities that may arise. How to manage credit effectively. The key to avoiding over-indebtedness is effective credit management. Below, we provide practical strategies to help you use credit responsibly and avoid falling into the trap of excessive debt. 1. Only borrow what you can afford to pay back. One of the most important principles when using credit is to borrow only what you can comfortably afford. Before applying for a loan or using a credit card, make sure you can make the monthly payments without compromising your other needs. If you can't afford the credit right away, it may be better to wait or find an alternative way to finance the purchase. Tip: use a loan payment calculator or a financial planning tool to estimate how much the credit will cost each month and whether you can afford that amount without affecting your budget. 2. Keep a low balance on your credit cards. Excessive use of credit cards is one of the main causes of over-indebtedness. Credit cards have very high interest rates, and if you don't pay the balance in full each month, the interest can quickly add up. 30% rule. To avoid credit problems, try to keep your balance below 30% of your credit card limit. For example, if your limit is $5,000, try not to accumulate more than $1,500 in debt. Pay the balance in full. If possible, pay the balance in full each month to avoid interest charges. If you can't, pay as much as possible to reduce the debt faster. 3. Make additional payments. Whenever possible, make additional payments towards your debts. This will not only help you reduce your loan balance faster, but it will also save you money in the long run by reducing the interest you have to pay. Tip: if you have multiple debts, you can use the avalanche strategy. where you pay off the debts with the highest interest rates first, or the snowball strategy, which consists of paying off the smallest debts first to gain momentum. 4. Establish an emergency fund. An emergency fund is essential to avoid falling into debt when the unexpected happens. This fund should be enough to cover between 3 and 6 months of your essential expenses, which will allow you to face situations such as job loss or medical expenses without having to resort to expensive credit. Start small. If you don't have an emergency fund, start with a small goal, such as saving $500. Then gradually increase your fund until you reach a larger goal. 5. Don't use credit for unnecessary expenses. Credit should be used for important needs or for purchases that generate long-term value. Avoid using credit for impulse purchases or non-essential expenses. Before using your credit card, ask yourself if you really need that item or if you can wait until you have the funds available. Tip: if it is a non-essential purchase, try to save for it instead of using credit. This will allow you to avoid interest and pay for the purchase without getting into debt. 6. Review your credit report regularly. It is important to review your credit report regularly to make sure there are no errors or debts you don't recognize. A clean credit report will help you maintain a good credit score and allow you to access better credit terms in the future. Request your report for free. In many countries, you have the right to obtain a free credit report once a year. Take advantage of this opportunity to review your credit history and correct any errors. How to get out of over-indebtedness. If you are already in a situation of over-indebtedness, it is important to act quickly to avoid negative consequences. Here are some strategies to get out of debt. 1. Make a list of all your debts. Write down all the debts you have, including the amount, interest rates, and payment terms. This will help you get a clear picture of your situation and prioritize your payments. 2. Look for refinancing options. If you have several debts with high interest rates, you could consider consolidating them into a single loan with a lower rate. This will make it easier for you to pay off your debts and reduce the amount of interest you have to pay. 3. Consider professional advice. If you feel that over-indebtedness is difficult to manage, consider seeking help from a financial advisor or credit counseling agency. They can help you create a plan to get out of debt and improve your financial situation. Conclusion: effective credit management is essential to avoid over-indebtedness and achieve long-term financial stability. Using credit responsibly, keeping balances low, paying on time, and creating an emergency fund are some of the key strategies for managing credit effectively. Remember that credit is a powerful tool when used responsibly, but it can also be a dangerous trap if not managed properly. In the next chapter, The Psychology of Consumption, Making Smart Financial Decisions, we will explore how emotions and impulses affect our financial decisions and how to take control of our consumption decisions to avoid impulsive spending and the accumulation of unnecessary debt. Chapter 9: The Psychology of Consumption, Making Smart Financial Decisions. In this chapter, we will explore how consumer psychology influences our financial decisions and how we can take control of our spending habits. Consumer decisions are not always based on reason. They are often influenced by our emotions, impulses, and social pressures. Understanding the psychology behind consumption is essential to avoid falling into the traps of impulsive spending and to make smarter financial decisions that help us achieve our long-term goals. Why do we buy what we buy? Consumer behavior is complex and influenced by a variety of psychological and emotional factors. Often, we buy things not because we need them, but because of how they make us feel or because of what we think other people expect of us. Some of the most common reasons why we spend impulsively or unnecessarily include: 1. Emotions and mood. Many people turn to shopping as a way of dealing with their emotions. Stress, sadness, or anxiety can lead us to spend money to feel better. Impulse buying is often used as a way to temporarily escape negative emotions, although the relief is only temporary and the financial problems persist. 2. Social pressure and advertising. Society and the media have a huge impact on our consumer decisions. Advertising constantly bombards us with messages telling us that we need specific products to be happy, successful, or accepted. Social media also plays a role by showing an idealized version of other people's lives, which can create the feeling that we need to buy something to fit in or keep up. 3. The desire for instant gratification. We live in a world where everything is readily available, from online shopping to next-day delivery. This instant access to products can make us feel like we need to get something right away, without considering the long-term financial impact. Instant gratification drives us to make decisions without thinking about future consequences. 4. The scarcity effect. Limited offers or seasonal sales often appeal to the fear of missing out. This phenomenon, known as the scarcity effect, leads us to make hasty decisions for fear that the product or offer will disappear. This can lead us to buy things we don't really need. How to control impulsive decisions. Although we are all susceptible to consumer psychology, there are ways to take control of our purchasing decisions and manage our money in a more rational and planned way. Here are some strategies to avoid falling into the traps of impulse buying. 1. Recognize the emotions behind spending. One of the keys to avoiding impulse buying is to be aware of the emotions that influence our purchasing decisions. Before making a purchase, take a moment to ask yourself why you are doing it. Are you buying something because you really need it, or are you doing it to make yourself feel better, or because of the influence of social media? Tip: if you are considering an emotional purchase, pause and wait at least 24 hours before making a decision. This time will allow you to reflect and determine if it is really something you need, or if it is just a temporary emotional response. 2. Create a clear shopping plan. One of the best ways to avoid impulse buying is to have a clear plan before you go shopping or make an online purchase. This includes setting a budget. Before you buy something, determine how much you are willing to spend in that spending category. If the item you want to buy doesn't fit within your budget, reconsider whether it's really worth buying. Make a list. If you're buying food or household items, make a list of what you really need and stick to it. Avoid adding items that were not on the list, especially if they are things you have not planned in advance. Set spending limits. To avoid impulse buying, set spending limits for different categories, such as clothing, entertainment, food, etc. This will help you stay in control and avoid overspending. 3. Avoid shopping in stressful situations. When we are stressed, tired, or anxious, impulse buying is more likely. Negative emotions can cloud our judgment and make us more susceptible to making impulsive financial decisions. If you feel like you are making impulsive decisions due to stress, it is important to stop and reflect before making any purchases. Tip: if you feel overwhelmed by stress or anxiety, look for other ways to relax that don't involve spending money, such as exercising, reading, or meditating. This will help you reduce the urge to spend in order to calm your emotions. 4. Practice, pause, and reflect. Every time you feel tempted to make a purchase, especially a large or unplanned purchase, take a moment to reflect. Ask yourself, do I really need this? Does this expense bring me closer to my financial goals? Can I live without this product? Taking time to reflect will help you calm any impulse and make more informed decisions. 5. Eliminate temptations and distractions. Sometimes, impulse purchases happen simply because we are exposed to too many temptations. If you know you have problems resisting online shopping or store offers, eliminate the distractions that lead you to spend. Disable notifications from online stores. Many stores have notifications that alert you to new offers. These alerts can trigger impulse purchases. Turn off these notifications to reduce temptation. Avoid shopping without a specific purpose. If you don't have a clear goal when you go shopping, it's easy to be tempted to buy unnecessary things. If you don't have something specific to buy, it's better to stay at home or plan more intentional purchases instead. 6. Invest in experiences rather than material objects. Research shows that investing in experiences, travel, recreational activities, events, rather than material objects tends to generate greater satisfaction and happiness. Experiences provide lasting memories and enrich our lives in ways that material objects cannot. Tip: instead of spending on consumer products, think about investing in experiences that really add value to your life, such as a family vacation or learning a new skill. How to develop a responsible consumption mindset. The key to making smart financial decisions is to develop a responsible consumption mindset. Here are some practices you can incorporate into your daily life. 1. Be aware of your consumption habits. Stay aware of the emotions and thoughts that guide your purchasing decisions. Reflect on why you buy what you buy and whether those products really improve your life. 2. Develop a long-term mentality. Instead of seeking instant gratification, focus on the long-term rewards you get from saving and investing wisely. Remember that every consumer decision has an impact on your financial future. 3. Set up a fund for spontaneous expenses. If you need some flexibility to cover occasional purchases or enjoy small pleasures, set up a fund for this. However, make sure that this fund does not interfere with your savings for long-term goals. Conclusion. Consumer psychology plays an important role in the financial decisions we make every day. Often, the impulse to buy arises from temporary emotions or social pressures, but by being aware of these factors and applying strategies to make more thoughtful decisions, we can avoid impulsive spending and improve our financial health. Making smart financial decisions is not just about sticking to a budget, it's also about changing the way we think about money and consumption. In the next chapter, Retirement Planning, Securing the Future, we will take a closer look at how to plan for retirement and ensure a stable long-term financial future. Chapter 10, Retirement Planning, Securing the Future. In this chapter, we will address one of the most crucial aspects of financial education, planning for retirement. Many people tend to put off this topic, thinking that retirement is too far away, but the earlier you start planning, the easier it will be to achieve a comfortable and secure retirement. Planning for retirement is not just about saving, but also about making informed decisions about how to invest, how to manage your income, and how to guarantee yourself a worry-free financial future. Why is planning for retirement important? Retirement is a natural stage in life, and although some people depend on pensions or government programs, many others find that this income is not enough to maintain the lifestyle they want. If you wait until the last years of your working career to start saving for retirement, you may face financial difficulties when the time comes to retire. Planning ahead gives you several advantages. 1. More time to save and invest. The earlier you start, the more time you will have for your savings and investments to grow through compound interest. 2. Greater control over your finances. By planning for your retirement, you will be able to determine how much you need to save and how much you will need when you retire. 3. Avoid depending on other resources. Without proper planning, you could find yourself depending on Social Security or other government programs, which may not be enough to maintain your quality of life. How much do you need to save for retirement? The amount you need to save depends on several factors, such as the lifestyle you want to maintain in retirement, the amount of time you expect to be retired, and other resources you have available, such as pensions or insurance. However, there are some general principles that can help you determine an appropriate savings goal. 1. Determine your retirement income needs. A common rule of thumb is that you will need approximately 70% to 80% of your current income each year to maintain your lifestyle once you retire. This varies depending on your circumstances and your goals, but it is a good starting point. 2. Calculate how much you need to save annually. To reach your savings goal, you'll need to determine how much you should save annually. A basic formula for estimating this is to divide the total amount you need to save by the number of years you have until retirement. 3. Consider additional expenses. Expenses in retirement may include medical insurance, long-term health care, and recreational activities. Be sure to take these additional costs into account when planning for retirement. Strategies for saving for retirement. There are several strategies you can use to ensure that you will save enough for your retirement. Here are some of the most effective ones. 1. Contributions to retirement accounts. In many countries, there are specific retirement savings accounts that offer tax benefits, such as 401k plans in the U.S. or IRAs, individual retirement accounts. These accounts allow you to save money for your retirement while reducing your current tax burden. Automatic contributions. A simple way to make sure you are saving is to set up automatic contributions to your retirement account from your current account. This helps you save without having to think about it. Maximize your contributions. In many countries, there are annual limits on contributions to these plans. Whenever you can, try to contribute as much as possible to take full advantage of the tax benefits. 2. Investing in pension funds or mutual funds. Investing is a crucial part of saving for retirement. Pension funds and mutual funds can help you grow your savings over the long term. Diversification. When investing, it is important to diversify your assets. This means distributing your money among different types of investments, such as stocks, bonds, and real estate, to minimize risk. Index funds. Index funds are a popular choice for retirement, as they have low costs and offer an easy way to diversify. These funds track the performance of a stock market index, such as the S&P 500, allowing you to invest in a wide variety of stocks without having to choose individual companies. 3. Saving in high-yield savings accounts. While traditional savings accounts offer very little interest, some high-yield savings accounts can help you increase your retirement savings. Although it is not an option that makes your money grow quickly like stock investments, it is a safe way to accumulate money for the future. 4. Take advantage of your employer's contributions. If your employer offers a retirement plan with matching contributions, such as a 401k in the US, be sure to take advantage of it. This means that the employer will match your contribution up to a certain percentage, giving you free money for your retirement. Tip: always contribute at least the minimum amount necessary to get your employer's matching contribution, as it's basically extra money you won't want to pass up. 5. Lifestyle adjustments to save more. If your goal is to achieve a comfortable retirement, you may need to make some adjustments to your current lifestyle in order to save more. This may include reducing unnecessary expenses, such as eating out frequently, buying luxury goods, or spending on expensive entertainment. Saving more now can give you more freedom and security in the future. When to start saving for retirement? The answer is, the sooner, the better. The earlier you start saving and investing for retirement, the more time you have for your money to grow thanks to compound interest. If you start in your 20s, you can harness the power of time on your side. But even if you are closer to retirement, it is never too late to start saving and investing efficiently. Additional strategies to maximize your retirement. Assess your health needs. As we age, health expenses tend to increase. It is essential to consider how you will cover these costs, especially if you do not have adequate health insurance. Alternative investments. Investing in real estate, investment funds, or businesses can be a smart way to diversify your assets and generate passive income for retirement. Plan your legacy. If you're thinking about your retirement, it is also a good time to consider how you want your assets to be distributed after your death. Planning your will and considering a trust can help you ensure that your legacy is well managed. Conclusion: planning for retirement is one of the most important aspects of long-term financial management. By starting early and using strategies such as investing in retirement accounts, mutual funds, and diversifying your savings, you can ensure that you have enough money to live comfortably after you stop working. Don't underestimate the power of compound interest and the importance of small savings over time. In the next chapter, Insurance: Protecting What You've Built, we will explore how insurance can protect your assets and your financial future, ensuring that, no matter what happens, your wealth is protected and your loved ones are taken care of. Chapter 11. Insurance: Protecting What You Have Built. In this chapter, we will address the importance of insurance and how it can protect what you have built up over the course of your life, both in terms of assets and well-being. Insurance is an essential tool for minimizing financial risk and ensuring that, in the event of any unforeseen circumstances, you do not lose everything you have worked so hard to achieve. Although it is easy to think of insurance as an unnecessary expense, it is an investment in your security and peace of mind. Why is it important to have insurance? Life is full of uncertainties, and although we cannot foresee all possible risks or unexpected events, insurance allows us to protect ourselves from the financial consequences of those events. Having adequate insurance not only offers peace of mind, but is also a key part of a sound financial strategy. Insurance allows you to deal with emergencies, pay for unforeseen expenses, and prevent an unfortunate event from destroying your financial stability. The main benefits of having insurance are: 1. Financial protection against risks. Whether it's a car accident, a serious illness, or damage to your home, insurance covers the expenses that could jeopardize your personal finances. 2. Security for your loved ones. If you are the main breadwinner in a family, having life or health insurance can be essential to ensure that your loved ones do not suffer a financial burden if something happens to you. 3. Long-term security. Insurance is an investment in your future. Adequate insurance helps you ensure that you won't have to resort to loans or savings in an emergency. 4. Compliance with legal requirements. In some cases, having certain types of insurance is mandatory by law, such as car insurance. Having the right insurance ensures that you comply with legal regulations and avoid penalties. Important types of insurance. There are different types of insurance, and each has a specific purpose. Below, we will explore the most common ones and why it is important to consider them when building your financial plan. 1. Life insurance. Life insurance is one of the most important types of insurance, especially if you have financial dependents. Life insurance provides a sum of money to your beneficiaries in the event of your death. This can help your family cover immediate expenses, such as the funeral, mortgage, debts, and everyday expenses. Term life insurance. This type of insurance covers a specific period of time, for example, 10, 20, or 30 years. If you die during that period, your beneficiaries receive the payment. It is more accessible and affordable than permanent life insurance. Permanent life insurance. Unlike term life insurance, this type of insurance covers you for your entire life and can accumulate a cash value that you can use as an investment. However, the costs are generally higher. Tip: if you have dependents, such as young children or a spouse who depends on your income, term life insurance is a good option to ensure that your family is protected. 2. Health insurance. Health insurance is essential to cover medical expenses, from basic medical consultations to more complex treatments, such as surgery or serious illnesses. Without health insurance, medical costs can become a heavy financial burden that could be difficult to cover, even if you have savings. Private health insurance. In some countries, people have the option of taking out private health insurance that offers more comprehensive and affordable coverage. This insurance allows you to choose your doctors and hospitals and often includes additional services such as preventive treatments. Public health insurance. In many countries, there are public health systems where the government covers basic medical expenses. However, depending on the quality of the system, it may not cover all specialized services or treatments. Tip: be sure to review health insurance coverage to make sure it meets your needs, and don't forget to consider additional coverage, such as dental and vision care. 3. Car insurance. If you own a vehicle, car insurance is compulsory in many countries. This insurance covers damage to your vehicle and to other vehicles in the event of an accident. It also protects against theft and damage to your property. Liability insurance. This insurance covers damage to other people or property if you're responsible for an accident. It is the minimum type of insurance required by law in many places. Comprehensive insurance. This type of insurance covers damage to both your vehicle and others, even if you are responsible for the accident. It also covers theft, fire, and natural disasters. Tip: if you drive frequently or in areas with a high accident rate, it is advisable to have comprehensive insurance to ensure complete protection. 4. Home insurance. Home insurance protects your home and its contents in case of damage due to natural disasters, fire, theft, or accidents. If you own your home, this insurance is essential to protect your investment and your assets. Property insurance covers damage to the structure of the home and its contents, such as furniture, appliances, and personal belongings. Rental insurance. If you are a tenant, rental insurance covers your personal belongings inside the property you are renting. It does not cover the structure of the building, but it does protect your valuables. Tip: if you live in an area prone to natural disasters such as floods or earthquakes, make sure your home insurance covers these additional risks. 5. Disability insurance. Disability insurance is a form of protection that replaces a portion of your income if you are unable to work due to illness or accident. This type of insurance is particularly important if you are the sole income provider in your family or if you depend on your ability to work to maintain your lifestyle. Tip: research the options available and choose a plan that offers you adequate coverage for a sufficient period of time in case you are unable to work for a long time. How to choose the right insurance. Choosing the right insurance depends on your needs, your budget, and the level of protection you want. Here are some tips to help you make informed decisions. 1. Assess your personal needs. Before choosing any type of insurance, think about your personal situation. Do you have children who depend on you? Do you have valuable property or assets? Are you at risk of health problems? These factors will influence which types of insurance are most important to you. 2. Compare options and prices. Not all insurance is the same, and prices can vary significantly. Compare options from different providers and select the one that offers the best value for money, with the coverage you need. 3. Review the policy terms and conditions. Be sure to read and understand all the terms and conditions of the policy before purchasing insurance. Pay attention to exclusions, premiums, deductibles, and coverage limits. 4. Review your insurance regularly. Insurance needs can change over time, so it's important to review and adjust your policies regularly. For example, if you buy a house or have a child, you will probably need to update your life or home insurance. Conclusion: insurance is a fundamental part of a comprehensive financial strategy. It gives us peace of mind knowing that, in the event of the unexpected, we will be financially protected. From health to home, life to car, having the right insurance ensures that you can face risks and continue to build your financial well-being. By carefully assessing your needs and choosing the right coverage, you will be taking important steps to protect what you have worked to achieve. In the next chapter, Investment, Multiplying Your Resources, we will take a closer look at how to start investing and how to grow your money intelligently and efficiently to ensure a solid and prosperous financial future. Chapter 12, Investment, Multiplying Your Resources. In this chapter, we will explore the world of investments, how they work, and why they are fundamental to building a solid financial future. While saving is important, investing is the key to growing your money in the long term. While investing may seem intimidating to some people, understanding the basics and how to get started in a simple way is the first step to building wealth. Why invest? Investing is a way of putting your money to work so that it grows over time. Unlike saving, which simply involves keeping money in an account, investing involves placing your money in assets that have the potential to increase in value. Investing allows you to generate returns, which helps you beat inflation and reach your financial goals more quickly. Advantages of investing. 1. Capital growth. Investments have the potential to generate higher returns than simple savings. Over time, this accumulated growth can significantly multiply your capital. 2. Protection against inflation. Inflation reduces the purchasing power of money over time. By investing, you can generate returns that offset the impact of inflation on your money. 3. Generation of passive income. Some investments, such as bonds or real estate, can generate passive income, which means that you'll earn money on an ongoing basis without having to actively work for it. 4. Diversification. Investing in different types of assets allows you to diversify your portfolio, which reduces risk and increases the chances of obtaining positive returns in the long term. Types of investments. There are different ways to invest, and each type of investment has its own risks and benefits. Here are some of the most common types. 1. Stocks. Stocks are one of the most popular forms of investment. When you buy stocks, you buy a part of a company. As a shareholder, you can benefit from the appreciation of the stocks and the dividends that the company may distribute. Advantages. Shares can offer very high returns if the company grows and is successful. In addition, dividends provide passive income. Risks. Shares can be volatile, which means that their value can rise or fall rapidly depending on the company's performance and market conditions. Tip: if you decide to invest in shares, be sure to diversify your portfolio by investing in different sectors and companies. 2. Bonds. Bonds are a form of loan that you make to governments or companies. In exchange for lending you money, the bond issuer pays you interest at regular intervals and repays the face value of the bond when it matures. Advantages. Bonds are considered low-risk investments compared to stocks. They offer regular interest payments, which can provide a steady passive income. Risks. The main risk with bonds is that of default, i.e., the issuer not paying the interest or capital when due. They can also be affected by interest rates, which could cause them to lose value. Tip: bonds are an excellent option for those seeking stability and a regular income stream, but you should research the credit quality of the issuer before investing. 3. Real estate. Investing in real estate involves buying properties to generate passive income, either through renting the property or through an increase in its value. Real estate is one of the oldest forms of investment and offers a way to diversify your portfolio. Advantages. Real estate can generate steady passive income and also has the potential for long-term appreciation. It also offers protection against inflation. Risks. properties can be expensive, and the real estate market can be volatile. There are also risks associated with property management, such as maintenance costs and the possibility of no tenants. Tip: if you can't buy a property yourself, consider investing in real estate investment trusts (REITs) as a way to gain exposure to this sector without having to buy physical properties. 4. Mutual funds. A mutual fund is a collective investment where money from several investors is pooled to invest in a variety of assets, such as stocks, bonds, and other instruments. Mutual funds are managed by professionals who make investment decisions on behalf of investors. Advantages: mutual funds offer an easy way to diversify your investments, which reduces risk. In addition, mutual funds can be managed by professionals, which is useful if you have no investment experience. Risks: although diversification reduces risk, mutual funds are not free from losses. In addition, mutual funds generally charge management fees, which can reduce your returns. Tip: mutual funds are a good option if you prefer to delegate investment decisions to an expert and diversify your portfolio without having to buy individual assets. 5. Cryptocurrencies. Cryptocurrencies, such as Bitcoin, Ethereum, and others, have gained popularity as a form of investment over the last decade. Unlike traditional currencies, cryptocurrencies are not backed by governments or banks, but are based on blockchain technology. Advantages: cryptocurrencies have the potential to offer significant returns due to their volatility. In addition, some investors see cryptocurrencies as a form of protection against inflation. Risks: cryptocurrencies are highly volatile and can experience extreme fluctuations in value. In addition, they're still subject to regulatory uncertainty and security risks. Tip: if you decide to invest in cryptocurrencies, do so with caution and make sure you don't invest more than you are willing to lose, given their speculative nature. Strategies for successful investing. To maximize the potential of your investments, it is crucial to follow some key strategies. 1. Diversification. Diversification is the process of distributing your money among different types of assets, stocks, bonds, real estate, etc., to reduce risk. When diversifying, if one asset loses value, others can compensate, helping you protect your portfolio. 2. Long-term investing. Long-term investing is a strategy that involves holding on to your investments for years or even decades. Although markets can be volatile in the short term, the value of your investments tends to grow over time if they are kept in the market. 3. Reinvesting profits. One of the best ways to make your money grow is to reinvest the returns you get from your investments, such as dividends or interest. By reinvesting, you take advantage of compound interest, which allows you to generate returns on returns. 4. Keep your emotions in check. Investments can be volatile, and market fluctuations can lead to fear or anxiety. It is important to keep your emotions in check and not make impulsive decisions based on panic or greed. Stay focused on your long-term goals. Conclusion: investing is one of the most effective ways to generate wealth in the long term. While it carries risks, it also offers the possibility of obtaining significant returns and reaching your financial goals more quickly. The key is to understand the different types of investments available, diversify your portfolio, and adopt a long-term mindset. Over time, your investments can work for you, providing you with greater financial security and helping you achieve economic freedom. In the next chapter, The Dangers of Overdrafts and Bank Fees, we will explore how to avoid unnecessary charges and how to maintain control over your finances so that you can maximize your savings and investments. Chapter 13. The Dangers of Overdrafts and Bank Fees. In this chapter, we will address two crucial aspects of financial management that often go unnoticed, but which can have a big impact on your financial health: overdrafts and bank charges. Both concepts are closely related to the management of bank accounts and, if not managed properly, can result in unnecessary charges that drain your resources. Here you will learn how to avoid these risks and how to make more informed financial decisions to protect your money. What is overdraft? Overdraft occurs when you spend more money than you have available in your bank account. This can happen accidentally, such as when you overpay or forget an outstanding balance, but it can also be the result of general mismanagement of your finances. When you overdraw, your bank will usually cover the missing amount, but in return, It will charge you a fee for each transaction that exceeds the available balance. This can quickly turn into a cycle of costly debt if not corrected immediately. Risks of overdraft. 1. High fees. Banks usually charge a fee every time an overdraft occurs, which can be $30 to $40 for each transaction. If you make multiple transactions in a day or in a week, these charges can add up quickly. 2. Debt cycle. If you don't cover the overdraft quickly, the outstanding balance will increase due to interest and fees. This can make it increasingly difficult to break out of the debt cycle. 3. Damage to credit history. Repeated and unresolved overdrafts can damage your credit score. Banks can report these incidents to credit agencies, making it difficult to obtain loans or open accounts in the future. How can you avoid overdrafts? Avoiding overdrafts is essential for keeping your finances under control. Here are some key strategies to avoid falling into this trap. 1. Monitor your accounts regularly. One of the first steps to avoid overdraft is to constantly monitor your income and expenses. Many people fall into overdraft simply because they lose control of how much money they have available in their accounts. You can do this easily using banking apps or financial management programs that allow you to see the status of your accounts in real time. Tip: set up automatic alerts with your bank so that they notify you when your balance is low. This will help you avoid additional expenses that could put you at risk of overdraft. 2. Keep a cushion of money in your account. It is advisable to always have a small cushion in your account to cover the unexpected. An emergency fund is useful not only for dealing with difficult situations, but also for avoiding overdraft. This cushion can be as simple as having an additional 10 to 20% of your monthly balance as a safety margin. Tip: if possible, set a target for your minimum monthly balance and make sure you keep it above that threshold at all times. 3. Use a debit or credit card with control. If you prefer not to carry large sums of cash, make sure you use a debit card that is linked directly to your checking account. That way, you won't spend more money than you have available in your account. Avoid using credit cards if you don't have a clear plan to pay off the total balance at the end of the month, as high interest rates can quickly lead to unnecessary debt. 4. Apply for overdraft protection. Some banks offer an overdraft protection option, where they allow you to link your checking account to a savings account or a line of credit that will cover the overdraft in case it occurs. While some banks charge a fee for the service, it may be worth it if you're prone to spending more than you have available from time to time. Tip: make sure you understand the fees and conditions associated with overdraft protection, as some banks charge fees for each incident. What are bank fees? Bank fees are charges that banks apply for various services they provide, such as account maintenance, transfers, use of ATMs outside the network, and more. Although some fees are unavoidable, we can often avoid them simply by knowing the bank's policies and making more informed decisions. Common types of bank fees. 1. Account maintenance fee. Some banks charge a monthly or annual fee to keep your account open. This fee is usually small, but if you don't pay attention, it can add up over time. 2. Overdraft fee. As mentioned above, banks charge fees every time you overdraw your account, which can result in a significant expense if not managed properly. 3. Fee for using ATMs outside the network. If you withdraw money from an ATM that does not belong to your bank, you are likely to be charged a fee. In some cases, both the bank that owns the ATM and your bank may apply fees for the service. 4. Transfer fee. Some banks charge fees for money transfers, especially international transfers or urgent transfers. Make sure you know the fees before making a transfer. How to avoid unnecessary bank fees. 1. Choose a bank with low or no fees. Nowadays, many banks offer accounts with no monthly maintenance fees. Research the options available in your area and choose the one that offers the best benefits without additional costs. Tip: make sure the account has no fees for maintenance, transfers, or ATM use if possible. 2. Use your bank's ATMs. To avoid fees for using non-network ATMs, try to use only ATMs belonging to your bank. If you have to use a non-network ATM, find out if your bank offers any options for reimbursing the fees for using non-network ATMs. 3. Set up automatic payments and electronic transfers. To avoid transfer fees and make sure your account stays up to date, set up automatic payments and electronic transfers. This will not only reduce fees, but also help you organize your payments efficiently. 4. Maintain a minimum balance in your account. Some banks require you to maintain a minimum balance in your account to avoid fees. Although it is not always convenient to have a high minimum balance, if possible, maintain the amount necessary to avoid insufficient funds charges. Conclusion: avoiding overdrafts and bank charges is crucial to keeping your finances in order and protecting your savings. With a little attention and planning, you can minimize the risks of unnecessary charges and improve the efficiency of your financial management. Keep a close eye on your accounts, set up an emergency fund, and choose the banking services that best suit your needs without imposing unnecessary fees. In the next chapter, Debt Refinancing, Strategies for Reducing Payments, we will explore how to manage existing debts, how to refinance them to obtain better conditions, and how to reduce your monthly payments without jeopardizing your financial stability. Chapter 14, Debt Refinancing, Strategies for Reducing Payments. In this chapter, we will explore one of the most useful tools for improving your financial situation if you are dealing with debt refinancing. Refinancing your debts allows you to restructure them to obtain more favorable conditions, such as lower interest rates or longer repayment terms. This process can help you reduce the amount of your monthly payments, ease your financial burden, and, in the long term, allow you to get out of debt more quickly. What is debt refinancing? Debt refinancing consists of replacing a loan or several existing debts with a new loan with better conditions. The new loan may have a lower interest rate, a longer term, or a combination of both, allowing you to adjust your monthly payments to your possibilities. Refinancing can be applied to different types of debt, such as personal loans, credit card debt, car loans, or mortgages. Benefits of debt refinancing. 1. Reduction of monthly payments. The main advantage of refinancing is that it can reduce your monthly payments by extending the term of the loan or reducing the interest rate. 2. Lower interest rates. If you have a good credit history, you could qualify for a lower interest rate than the one you are currently paying. This can save you a significant amount of money over time. 3. Simplification of payments. If you have several debts, you can refinance them into a single loan. This will help you consolidate your payments and reduce the risk of forgetting a payment or paying additional fees. 4. Better control over your finances. Refinancing allows you to establish more manageable conditions, giving you greater control over your budget and your ability to pay debts on time. When is the right time to refinance? Debt refinancing is not always the best option. Before deciding whether to refinance, consider the following factors. 1. When your interest rates are high. If you are paying a high interest rate, especially on credit cards or personal loans, refinancing can be an excellent way to reduce those costs. With a lower rate, the money you pay each month goes more towards reducing the principal balance rather than paying interest. Tip: if you have a credit card with a high interest rate, consider refinancing it with a personal loan with a lower rate. This will reduce the total cost of the debt. 2. When your financial situation has improved. If your financial situation has improved and you now have a better credit history or higher income, you may qualify for more favorable loan terms. This may include lower interest rates or the possibility of consolidating your debts into a single payment. Tip: if you have a higher credit score than when you took out the original debt, it is a good time to consider refinancing. 3. When you are struggling with high payments. If your monthly payments are difficult to manage, refinancing can be useful by extending the term of the loan. This will reduce the amount you need to pay each month, easing the pressure on your budget. Tip: although extending the repayment term can reduce your monthly payments, keep in mind that you will pay more interest in the long run, so you should evaluate whether this is the best option for you. Debt refinancing strategies. There are different strategies for refinancing your debts depending on your financial situation and the type of debt you have. Here are some options you might want to consider. 1. Debt consolidation. Debt consolidation is a way of refinancing multiple debts into a single loan. This is useful if you have several debts with different creditors and want to make a single monthly payment. Debt consolidation loans. You can take out a personal loan to pay off all your debts and then make a single monthly payment at a lower interest rate. Credit card balance transfer. Many credit cards offer balance transfer promotions with a low interest rate or even 0% for a limited time. This can be an excellent option for consolidating credit card debt and paying less interest. Tip: make sure the consolidation loan or balance transfer card has a lower interest rate than the debts you are consolidating so that you really get benefits. 2. Mortgage refinancing. If you have a mortgage, you can consider refinancing to get a lower interest rate, reduce the term of the loan, or convert a variable rate mortgage to a fixed rate mortgage. Fixed rate refinancing. If you have a variable rate mortgage, you can swap it for a fixed rate mortgage to make sure your monthly payments don't increase if interest rates go up. Refinancing to reduce the term. If you have enough margin in your budget, you could refinance to reduce the term of your mortgage and pay it off faster, which will save you money on interest in the long term. Tip: make sure you calculate all the costs associated with refinancing your mortgage, such as closing fees and commissions, to ensure you will actually make savings in the long term. 3. Refinancing student loans. If you have student loans, refinancing can help you get a lower interest rate or change the term of the loan to better suit your budget. Federal versus private loans. If you have federal loans, refinancing is often done with private lenders. However, keep in mind that by refinancing with a private lender, you will lose certain benefits of federal loans, such as the ability to defer payments or access income-based repayment plans. Tip: before refinancing federal student loans, carefully evaluate the benefits you could lose and consider whether the lower interest rate justifies this loss. How to refinance effectively. To refinance effectively, follow these key steps. 1. Evaluate your financial situation. Before beginning the refinancing process, evaluate your financial situation and determine if it is really the right time to do so. If you can't get a significantly lower interest rate, or if your financial situation is uncertain, you may need to wait. 2. Research different lenders. Don't limit yourself to your current bank. Research refinancing options from different lenders, including credit unions, online lenders, and traditional lenders, to make sure you get the best terms. 3. Compare interest rates and associated costs. Make sure that the benefits of refinancing, such as a lower interest rate or lower payments, outweigh the associated costs, such as commissions or closing fees. 4. Review your payment terms. Make sure that the new loan has terms that match your ability to pay. If the term is longer, your monthly payments will be lower, but you could end up paying more in interest over time. Conclusion: debt refinancing is a powerful tool for reducing monthly payments, obtaining better conditions, and, ultimately, improving your financial health. When considering refinancing, it is important to assess your financial situation, research the available options, and make sure that refinancing offers you a real benefit in terms of long-term savings. In the next chapter, Financial Education in the Family, Teaching the Youngest, we will explore how to instill sound financial principles in the youngest members of the family to ensure that future generations are better prepared to manage their money responsibly. Chapter 15, Financial Education in the Family, Teaching the Youngest. In this chapter, we will explore how financial education is not only crucial for adults, but also for younger generations. Teaching children and teenagers about money, saving, budgeting, and investing from an early age is one of the best ways to ensure that they are better prepared to face the financial challenges of adulthood. Financial education in the family is an ongoing process that should include practical lessons and a positive mindset towards money management. Why is financial education important for young people? Financial education is a vital skill that many people do not learn formally at school. However, it is essential for making responsible decisions about money and avoiding financial problems in the future. Young people who grow up understanding how to manage their finances are more likely to avoid excessive debt, save for important goals, and make smart investment decisions. Benefits of financial education in the family. 1. Development of decision-making skills. Young people who understand how money works are more likely to make informed and responsible financial decisions, which will help them avoid problems such as excessive debt and impulsive spending. 2. Encouraging financial responsibility. Learning to manage money teaches them to be responsible and to take control of their finances, which will help them to be more autonomous and confident in their adult life. 3. Preparation for financial independence. A good financial education prepares young people to be economically independent, which will allow them to make more informed decisions and achieve financial freedom more quickly. 4. Better preparation for crisis situations. Teaching them how to save, invest, and manage financial contingencies gives them the tools they need to face difficult times, such as job losses or family emergencies. How to teach financial literacy to young people. There are several ways you can teach your children or young relatives about personal finance. The most important thing is to create an open environment where they can learn and practice these concepts in a practical way. 1. Start with the basics. What is money? Before delving into complex concepts, it is essential that children understand what money is and how it is earned. At an early age, you can explain the concept of work and how people earn money in exchange for services or products. This is the first step in understanding the basic economic cycle. Tip: use simple examples that they can understand, such as explaining how your children can earn money doing chores or selling things they no longer need. 2. Teach them about saving. One of the most valuable lessons you can teach them is the importance of saving. Children should understand that money should not always be spent immediately, but should be saved for the future, for things that really matter. Create a piggy bank. Younger children love saving in a piggy bank. Teach them to divide their money into parts. One part to save, one part to spend, and, if possible, one part to donate. Savings account. As they get older, you can open a savings account for them at the bank. This will give them an idea of how money can grow over time thanks to compound interest. Tip: encourage your children to set savings goals, such as saving for a toy or a family trip. This will teach them patience and the satisfaction of achieving financial goals. 3. Introduction to budgeting. Children and teenagers should learn to manage their money responsibly. Budgeting is a key tool in financial education, as it teaches them to manage their income and expenses. Teach them to plan. Use a simple budget to help them organize their money. This includes identifying their sources of income, such as pocket money, gifts, etc., and allocating specific amounts for saving, spending, and donating. Use of apps and tools. As your children grow older, you can teach them to use budgeting apps that are adapted for young people. These apps will allow them to have more precise control of their finances. Tip: if they have a small amount of money, such as a salary from occasional jobs, teach them to use a simple budget. Show them how to allocate one part for savings and another for expenses. 4. Investment. A key concept for the future. As children and teenagers mature, you should start to introduce more advanced concepts such as investment. You can begin by explaining how investments can make money grow over time. Simulate investments. There are games and online simulators that can teach them how the stock market works and how investments can generate profits. You can also talk about saving for retirement and how long-term investments can secure their future. Invite them to reflect on risk. Teach them that although investing can be lucrative, it also carries certain risks. Help them understand that, with a good strategy and patience, investing can be a smart way to make money grow. Tip: explore investment simulation games or invest in a small fund so that your children can see how investing works in practice. 5. Instill responsible consumer habits. It is important that young people learn to make responsible financial decisions. Teaching them not to spend impulsively and to compare prices before making purchases are habits that can help them manage their money better. Keep track of expenses. Get your children into the habit of making lists before shopping and not buying things they don't need. This will teach them to make more thoughtful spending decisions. Teach the value of money. Make your children understand that money doesn't just appear. If they have their own money to spend, encourage them to use it strategically. Tip: do family activities such as shopping, where you can teach them to compare prices and make decisions based on value, not just on appearance or immediate desire. How to involve the whole family in financial education. Financial education doesn't have to be the sole responsibility of parents. The whole family can participate in this process. Creating a family culture that values good financial management can lay a solid foundation for future generations. 1. Hold family meetings about money. Make financial education a regular topic of conversation at home. Make sure that everyone, including children, understands how the family's finances are managed. This may include discussing the family budget, savings goals, and efforts to reduce debt. 2. Model responsible financial behavior. Children learn by observing, so it is essential that you also practice good financial management. If you see that your children are watching you making smart decisions, such as saving or investing for the future, they will be more inclined to follow your example. Conclusion: financial education in the family is a long-term investment in the economic well-being of all its members. By teaching young people about money management, saving, budgeting, and investing, you not only give them the tools to make responsible financial decisions, but also help them create a solid foundation for a successful financial life. As a parent or guardian, you are your children's first role model, and what you teach them today can have a positive impact on their future. In the next chapter, The Psychology of Saving, Developing Healthy Financial Habits, we will look at how to cultivate a positive mindset towards saving and how to create habits that will enable you to achieve your long-term financial goals. Chapter 16, The Psychology of Saving, Developing Healthy Financial Habits. In this chapter, we will explore how to cultivate a positive mindset towards saving and how to develop healthy financial habits that will help you achieve your long-term goals. Saving is not just about putting money aside. It's about establishing a mindset that prioritizes financial well-being and making conscious decisions that allow you to achieve your goals without sacrificing too much in the present. Why is saving important? Saving is a fundamental pillar of financial education. Without constant and planned saving, it is difficult to achieve financial independence, have security in the face of unforeseen events, or achieve major goals, such as buying a house or retiring. However, many people struggle to save due to emotional and psychological factors that influence their financial decisions. Benefits of saving. 1. Financial security. Saving provides you with a cushion for emergencies, enabling you to face unexpected situations, such as job loss or unforeseen medical expenses, without getting into debt. 2. Financial independence. Saving and investing effectively is the basis for financial independence. As you save and grow your resources, you will not be as dependent on your job for living and will be able to enjoy greater freedom. 3. Achievement of long-term goals. Disciplined saving allows you to achieve your financial goals, whether for a trip, buying a house, your children's education, or retirement. 4. Less financial stress. Having savings helps you feel more secure and reduces money-related stress. You won't have to worry as much about unexpected payments or financial crises if you have an emergency fund. The psychology of saving. Why do we find it so hard to save? The act of saving is closely related to our psychology. The way we see money, the present and the future influences our financial decisions. Often, the lack of savings is due to emotional behavior, limiting beliefs, or the search for instant gratification. Psychological factors that affect saving. 1. Instant gratification. We live in a society where instant rewards are at our fingertips. Buying something now gives us immediate pleasure, but this often comes at the expense of long-term saving. It is difficult to resist the temptation to spend when an immediate reward is perceived. 2. Lack of long-term planning. People often don't think about the future and tend to focus on the present. Saving for retirement or for a future emergency can seem irrelevant when we have immediate expenses to attend to. 3. Limiting beliefs about money. Many people grow up with limiting beliefs about money, such as the idea that I'm not good with money or money is something difficult to earn. These beliefs can negatively influence our ability to save and grow our resources. 4. The fear of not having enough. Some people feel that even if they save, it will never be enough to meet their needs. This fear can paralyze them and prevent them from starting to save, as they think it's not worth it if they can't save large amounts. Strategies for cultivating a savings mindset. Overcoming the psychological obstacles to saving and developing a positive mindset towards money can take time, but with the right strategies, it is possible to change our financial habits and improve our ability to save. 1. Set clear and achievable goals. One of the main reasons why many people do not save is the lack of clear goals. Saving for the sake of saving may not have the same motivation as doing so for a specific purpose. Setting clear goals gives you a purpose and keeps you focused in the long term. Short-term goal. An attainable goal, such as saving for a vacation or for the purchase of a new appliance. Long-term goal. Saving for retirement or for the purchase of a house. Tip: divide your big goals into smaller, achievable goals. This will allow you to celebrate your achievements as you go along and keep you motivated. 2. Automate your savings. One of the most effective ways to save is to automate the process. If you have to make a conscious effort every time you save, it's easy to forget or postpone saving. Automation removes this obstacle and ensures that saving is consistent. Set up automatic transfers. Set up automatic transfers from your checking account to a savings account every time you receive your salary. You can set a fixed percentage or a specific amount. Automatic savings in your banking applications. Many banking applications allow you to round up purchases and automatically save the excess change. This is ideal for those who struggle to save large amounts of money at first, but can still save small amounts consistently. 3. Visualize your goals. Visualizing your financial goals is a powerful strategy for staying motivated. By having a visual representation of what you are saving, you can feel more connected to your goals and more motivated to keep saving. Vision boards. Create a vision board with images of your goals, such as the house you want to buy or the vacation you plan to take. This will constantly remind you why you are saving. Visual savings tracking. Use apps or charts to keep a visual record of your savings. This will help you see how your funds grow over time. 4. Make saving a priority. Make saving a priority, not just something you do if you have money left over. Just as you pay your bills and essential expenses, put saving first. Treat saving as a fixed expense that you must meet before spending on anything else. Tip: imagine that you are paying yourself every time you save. This approach will help you internalize the importance of saving and put it in the same category as other important payments. 5. Change your consumer mindset. An essential part of saving is changing the way you think about consumption. Instead of seeing spending as a way to get instant gratification, start seeing saving as a way to enjoy long-term well-being. Here are some ways to change your mindset. Avoid impulse buying. Every time you want to buy something you don't need, stop and think about whether it's really worth it. Ask yourself if the purchase will contribute to your long-term goals, or if it will only give you instant gratification. Culture of delayed gratification. Deferred gratification is the ability to resist the temptation to spend today in order to enjoy a greater reward in the future. Practicing this can help you develop a healthier relationship with money. 6. Celebrate small achievements. It is important to recognize and celebrate your achievements on the road to saving. Every time you reach a goal, whether it is saving for an emergency fund or completing your monthly savings target, celebrate that achievement. This will keep you motivated and reinforce your commitment to saving. Tip: celebrate in a simple and meaningful way. Don't spend the money you saved, but allow yourself to enjoy small moments of reward that won't destroy your financial progress. Conclusion: saving is not just a financial act, but also a change in mindset. By developing healthy financial habits and a positive mindset towards saving, you can ensure a more stable future and achieve your long-term personal and financial goals. It's not just about saving money, it's about making conscious decisions that allow you to enjoy financial security and freedom. In the next chapter, the importance of entrepreneurship, generating new sources of income, we will discuss how entrepreneurship can be an excellent way to improve your financial situation and achieve greater levels of economic stability. Chapter 17. The importance of entrepreneurship, generating new sources of income. In this chapter, we will explore how entrepreneurship can be a powerful tool for improving your financial situation and creating new sources of income. Entrepreneurship not only offers the possibility of earning additional income, but also allows you to have greater control over your economic future, develop valuable skills, and achieve levels of financial independence that would be difficult to achieve with traditional employment alone. Why is entrepreneurship key to financial independence? Entrepreneurship is essential for those who want to achieve financial independence because it offers multiple ways to generate income without relying on a fixed salary. Although starting a business or entrepreneurial project involves risk and effort, it can offer greater financial rewards in the long term. It also gives you the opportunity to diversify your sources of income, reducing your vulnerability to job instability. Benefits of entrepreneurship. 1. Financial independence. Through your own business, you have full control over your income, allowing you to adapt quickly to changes in the market and take advantage of new opportunities. 2. Generation of multiple sources of income. Entrepreneurship allows you to explore different ways of generating money, whether through the sale of products, the provision of services, the creation of content, among others. 3. Personal and professional growth. As an entrepreneur, you acquire valuable skills in areas such as decision-making, team management, sales, and marketing, which makes you a more well-rounded and versatile individual in the professional sphere. 4. Possibility of scaling up the business. As your business grows, so will the opportunities to generate more income. A well-established business can offer you a more stable and lucrative source of income than a traditional job. What does it take to be a successful entrepreneur? Although entrepreneurship offers many advantages, it is not an easy path. To be successful, you need a combination of skills, preparation, and the right mindset. Here we discuss some of the key factors that can help you become a successful entrepreneur. 1. Entrepreneurial mindset. Mentality is one of the most important factors for success as an entrepreneur. A willingness to learn, resilience in the face of failure, and the ability to adapt to circumstances are key qualities that an entrepreneur must cultivate. Successful entrepreneurs do not give up easily. They see failures as learning opportunities and always look for solutions rather than focusing on problems. Tip: develop a growth mindset. Always look to improve and learn from mistakes along the way. 2. Identifying business opportunities. The first step to becoming an entrepreneur is to identify a viable business opportunity. This involves researching the market, identifying unresolved problems or areas where you can offer a unique product or service. Business opportunities can arise in various sectors, such as technology, health, education, entertainment, and many more. Look at your interests and skills. A good business usually arises from a combination of what you are passionate about and what you know how to do well. Think about your strengths and abilities and how you can use them to solve problems in the market. Research market demand. Make sure there is a real demand for the product or service you want to offer. Market research is essential to assess the viability of your idea. 3. Strategic planning. The success of any venture depends largely on a good business plan. Strategic planning helps you define your vision, set clear goals, and chart a path to success. A well-structured business plan should include executive summary, an overview of your business, your mission, and your goals. Market analysis, an analysis of the competition, the target audience, and the opportunities in the market. Marketing and sales strategy, how you will attract and retain customers, as well as the tactics you will use to generate sales. Financial projections, an estimate of expected income and expenses, as well as a strategy for profitability. Tip: don't be afraid to adjust your business plan as you go along. The market and circumstances change, and your plan should be flexible to adapt to those changes. 4. Efficient financial management. Proper financial management is crucial to the success of any venture. Make sure you have a clear handle on your business's income and expenses. This will allow you to make informed decisions about investment, spending, and growth. In addition, having a business emergency fund is essential to deal with unforeseen events without jeopardizing the financial stability of your business. Tip: keep your personal finances clearly separate from your business finances. This will help you avoid tax and financial problems. 5. The power of marketing and sales. The ability to promote and sell your products or services is essential to attract customers and generate income. Digital marketing, social media, and sales strategies are powerful tools you can use to reach a wider audience. Social media. Platforms like Facebook, Instagram, and LinkedIn allow you to reach thousands of people affordably. Use these tools to build your brand, promote your products, and connect with your audience. Paid advertising. If you have the budget, consider investing in paid ads to increase your visibility. Google Ads and Facebook ads are effective options for reaching potential customers. Tip: effective marketing is not just about selling, it's also about building a relationship of trust with your customers. Offer value and educate your audience about how your product can improve their lives. When to start. The right time to start up a business depends on your personal and professional situation. However, some factors that may indicate that the time is right to take the leap include having a clear business idea. If you have a solid idea and a well-defined plan, the time may be now. Financial stability to take risks. Although it is not necessary to have large sums of money, having a savings cushion is useful to finance the first months of operation and cover possible initial losses. Desire for independence. If you feel you are ready to take control of your financial life and are willing to take responsibility for your successes and failures, then it is time to get started. Conclusion. Entrepreneurship is a powerful way to improve your financial situation, achieve financial independence, and reach your personal goals. Although it requires hard work, dedication, and perseverance, the long-term benefits can be enormous. With an entrepreneurial mindset, a strategic plan, and proper financial management, you can build a successful business that not only provides you with additional income, but also allows you to have more control over your life and your financial future. In the next chapter, Managing Variable Income, Financial Flexibility, we will talk about how to handle unstable income and how to keep your finances under control in times of economic fluctuation. Chapter 18, Managing Variable Income, Financial Flexibility. In this chapter, we will explore how to effectively manage variable income, a common situation for many people, especially those who are entrepreneurs, self-employed, or employed in sectors with fluctuating incomes. The ability to manage variable income effectively is crucial to maintaining financial stability in any type of economic environment. Having a clear strategy for handling these variations can make the difference between financial success and uncertainty. What is variable income? Variable income is income that does not follow a fixed or regular pattern, but fluctuates according to factors such as the demand for products or services, sales commissions, seasonality, or individual performance. Self-employed workers, freelancers, entrepreneurs, artists, and salespeople often have variable incomes as they depend on specific projects, contracts, or sales, which can vary from one month to another. Examples of variable income. Freelancers. A graphic designer or freelance writer may have projects in some months and fewer in others. Entrepreneurs. Small business owners may see fluctuations in sales according to the season or market demand. Sales commissions. Salespeople receive a portion of their salary based on commissions for each sale made, which generates variable income. Why is it important to learn how to manage variable income? Variable income can create financial uncertainty, as there is no predictable amount of money coming in each month. This can make it difficult to manage your finances, pay your bills on time, or save for the future. However, with the right strategies, you can manage these fluctuations effectively and ensure that your financial well-being is not compromised. Benefits of managing variable income correctly. 1. Financial stability. Despite the ups and downs, you can maintain financial stability if you're able to plan and budget properly. 2. Greater control over your money. Managing variable income allows you to have greater control over how you distribute your resources, ensuring that you can meet your essential needs and save for the future. 3. Reduction of financial stress. Having a clear strategy for managing the lean months will allow you to face fluctuations without worrying too much about the lack of income. 4. Better savings capacity. If you learn to live with what you have in the good months and save a portion for the more difficult months, you can have an emergency fund that will help you stay calm when income drops. Strategies for managing variable income. Managing variable income requires discipline and a strategic approach. Here are some key strategies you can implement to ensure your finances remain healthy, even when income fluctuates. 1. Set a flexible budget. A budget is essential for managing your finances, especially when income is not constant. However, when dealing with variable income, it is important to have a flexible budget that you can adjust according to the flow of money you receive each month. Define your essential needs. Prioritize your basic expenses, such as housing, food, utilities, and transportation. Make sure these expenses are covered regardless of fluctuations in your income. Categorize your expenses. Divide your expenses into categories such as essential, discretionary, and savings. This will help you identify areas where you can cut expenses when income is low. Adjust your budget monthly. At the beginning of each month, evaluate how much you expect to earn and adjust your budget based on that amount. If the expected income is low, cut expenses in non-essential categories. Tip: use budgeting apps that allow you to make adjustments quickly based on the amount of your variable income. Some apps also allow you to sync with your bank accounts for real-time tracking. 2. Create an emergency fund. An emergency fund is an essential part of financial planning for those with variable incomes. This fund provides you with a financial cushion that will allow you to face months of low income without compromising your stability. Set a savings goal. An emergency fund should be enough to cover 3 to 6 months of your essential expenses. If you have variable income, it may be advisable to have a larger emergency fund. Contribute to the fund consistently. Even if you can only save a small amount each month, do it consistently. In months with higher income, you can increase contributions to the emergency fund. Tip: keep the emergency fund in a separate and accessible account, but not so accessible that it is easy to spend on unnecessary expenses. 3. Save and invest in the good months. The months when you have more income are the perfect opportunity to save and invest for the leaner times. While it may be tempting to spend the extra money on luxuries, it's smarter to set some aside for when your income drops. Automate your savings. Set up automatic transfers to your savings or investment accounts so you don't have to think about it. Set aside a percentage of your income to save and invest regularly. Diversify your investments. Consider investing in products that suit your risk profile, such as index funds, stocks, bonds, or real estate. Diversification is key to minimizing risk and achieving stable long-term returns. 4. Manage your debt payments. If you have debts, make sure you manage them so that they don't become an additional obstacle when your income is low. Debt can accumulate quickly if it is not paid on time, which will generate interest and additional charges. Make minimum payments when necessary. If your income is low, prioritize minimum payments to avoid non-payment charges, but try to make additional payments when you have a surplus of money. Consolidate or refinance your debts. If you have several debts with high interest rates, consider consolidating them into a single loan with a lower interest rate. This will reduce the amount of your monthly payments and help you to manage your finances better. Tip: if you have debts, work on a plan to gradually reduce them. The faster you pay, the less interest you will have to pay in the long run. 5. Look for additional income. If your income is unpredictable, looking for additional sources of income can be an excellent way to balance out the fluctuations. This will allow you to have more financial stability. Freelancing or temporary jobs. If you have skills to offer, consider working as a freelancer or looking for temporary jobs in your area of expertise. Passive income. Consider ways to generate passive income, such as renting out property, investing in dividend-generating funds, or creating digital content that generates recurring income. Conclusion: managing variable income is a challenge, but with the right strategies, you can achieve lasting financial stability. By setting a flexible budget, saving and investing in the good months, creating an emergency fund, managing debts, and looking for additional sources of income, you can maintain a financial balance, even when your income fluctuates. The key is to have a disciplined and proactive approach, which allows you to make the most of the good months and stay in control when income decreases. In the next chapter, Evaluating Financial Products, Making Informed Decisions, we will discuss how to analyze and compare financial products, such as bank accounts, credit cards, and loans, to make informed decisions and choose the best options for your situation. Chapter 19, Evaluating Financial Products, Making Informed Decisions. In this chapter, we will explore how to evaluate and compare financial products in order to make more informed decisions that align with your financial goals. With a variety of options available on the market, choosing between bank accounts, credit cards, personal loans, and other financial products can be overwhelming. However, an analytical and well-informed approach can help you choose the best options for your situation and optimize your personal finances. Why is it important to evaluate financial products? Making informed decisions about financial products is essential to stay in control of your finances and make sure you are not overpaying or making decisions that could harm your financial health. Each financial product has its own characteristics, advantages, and disadvantages, so it is important to understand how they work before committing to them. Benefits of properly evaluating financial products. 1. Saving money. By choosing financial products with lower interest rates, lower fees, and better conditions, you can save a significant amount of money in the long run. 2. Better financial planning. Once you understand how each financial product fits your needs, You'll be able to plan your finances more effectively, allowing you to reach your goals faster. 3. Reduction of financial risks. Properly evaluating financial products also helps you reduce the risks associated with debts, investments, and other products that could harm your financial stability if not managed properly. 4. Greater control over your money. Making informed decisions gives you more control over your money. By choosing the right products, you can maximize the return on your savings, minimize your expenses, and optimize your resources. How to evaluate financial products. Evaluating financial products involves examining a variety of factors, such as interest rates, service charges, payment terms, flexibility, and other key aspects that affect your financial experience. Below, we'll discuss how to effectively evaluate different types of financial products. 1. Bank accounts. Choosing the right option. Bank accounts are the foundation of your personal finances. It is crucial to choose an account that offers services that are right for your needs and minimizes fees and commissions. Here are some factors to consider when choosing a bank account. Type of account. There are different types of accounts, such as checking, savings, and investment accounts. Each type has a specific purpose, so be sure to choose the one that best suits your needs. If you only need to make daily transactions, a checking account may be sufficient, but if you want to save for the long term, a savings account might be more appropriate. Interest rates. Some savings accounts or current accounts offer interest rates on your deposits. Compare the rates offered by different banks to make sure you get the best possible return. Fees and charges. Make sure you understand all the fees associated with the account, such as maintenance fees, transfer fees, or fees for using ATMs outside the network. There are many account options with no monthly fees, so look for the one that best suits your budget. Tip: opt for bank accounts that offer online and mobile services, as this will make it easier to manage your funds and carry out transactions. 2. Credit cards. Comparing rates and benefits. Credit cards can be a useful financial tool, but it is essential to choose the right card for your situation. There are different types of credit cards, and each has its own benefits and associated costs. Here are some key points to consider. Interest rate, APR. The interest rate, or APR, annual percentage rate, is a crucial factor when choosing a credit card. If you plan to keep an outstanding balance on your card, a low interest rate will allow you to save on interest charges. If you intend to pay the full balance each month, the interest rate may not be as relevant. Rewards and benefits. Many credit cards offer rewards, such as points, miles, or cashback for purchases made. If you are responsible with payments, rewards cards can be an excellent way to maximize your daily purchases. Fees for additional charges. Be sure to know the fees for additional charges, such as late payments, fees for exceeding the credit limit, or for making purchases abroad. Tip: if you plan to use your credit card for everyday purchases, choose a rewards card that offers benefits you can take advantage of. If you can't pay off the balance in full each month, look for a card with the lowest interest rate. 3. Personal loans. Evaluating financing options. Personal loans can be a useful solution in times of cash need, but it is important to evaluate them carefully to avoid falling into costly debt. Here are some factors to consider when evaluating personal loans. Interest rate. The interest rate on a personal loan can vary significantly depending on the lender and your credit score. Compare rates from different lenders to find the cheapest option. Loans with lower interest rates will allow you to pay less interest over time. Payment term. Make sure the loan term is right for your ability to pay. Longer terms can lower your monthly payments, but will increase the total cost of the loan due to accrued interest. Shorter terms allow you to pay less interest, but monthly installments will be higher. Fees and additional charges. Some loans may have fees for opening the loan, for early repayment, or for late payments. Make sure you understand all the fees associated with the loan before committing. Tip: if you plan to use a personal loan to finance a major expense, such as buying a car or consolidating debt, compare interest rates, repayment terms, and fees to make sure the loan is affordable and cost-effective. 4. Investments. Evaluating funds and financial products. Investing is a crucial part of long-term financial planning. When evaluating investment products, such as mutual funds, stocks, bonds, and index funds, it is essential to understand the risks and potential returns. Here are some key points for evaluating investments. Historical profitability. Compare the historical performance of the funds or shares you're interested in. However, remember that past performance is no guarantee of future results. Risk and diversification. Assess the level of risk associated with each investment. Some investments, such as shares, have a high potential for return but also a high level of risk. Consider diversifying your investment portfolio to mitigate risk. Management fees. Mutual funds and other investment products often charge management fees. Make sure the fees are reasonable in relation to the expected return. Tip: if you are not sure which investments to choose, look for index funds or investment funds with a diversified portfolio that minimize risk and offer a stable return. Conclusion: evaluating financial products properly is essential for making informed decisions that optimize your resources. By comparing interest rates, fees, benefits, and risks, you can choose the products that best suit your financial needs and goals. The key is to conduct a detailed analysis of each option before committing, which will allow you to maximize your financial well-being and minimize unpleasant surprises. In the next chapter, Conclusion, Towards Financial Freedom, we will reflect on the lessons learned throughout the book and how to apply all this knowledge to achieve lasting financial stability and freedom. Chapter 20, Conclusion, Towards Financial Freedom. In this final chapter, we reflect on the key concepts discussed throughout the book and how you can apply what you have learned to achieve a stable and successful financial life. Financial education is not just a set of tools and strategies, but a comprehensive approach to achieving your personal goals, improving your economic well-being, and enjoying a more secure future. What is financial freedom? Financial freedom refers to the state in which a person has enough resources to live comfortably without depending on a salary or the decisions of others. It's not just about accumulating wealth, but about having full control over your finances, making informed decisions, and living on your own terms. Financial freedom allows you to reduce money-related stress and focus on the things that really matter, such as your relationships, your health, and your passions. Benefits of achieving financial freedom. 1. Reduction of financial stress. By not depending on a fixed income or living with debt, you can experience greater peace of mind and fewer worries about unforeseen financial events. 2. Greater control over time. Financial freedom allows you to decide how you spend your time. You will no longer be limited by the need to work long hours to cover your basic needs. 3. Opportunities to invest and grow. When you have financial freedom, you can afford to make investments that generate additional income or finance projects you are passionate about without being restricted by your daily financial obligations. 4. Ability to help others. With sufficient resources, you can dedicate yourself to causes that matter to you, whether it's supporting your family, investing in your community, or donating to charities. How to achieve financial freedom? Achieving financial freedom doesn't happen overnight, but with dedication, discipline, and planning, it is possible. Here is a summary of the keys to achieving it. 1. Continuous financial education. Financial education is a continuous process. There is always something new to learn about how to manage your money, save, invest, and plan for the future. Stay informed about best practices, new investment opportunities, and strategies to reduce expenses. Tip: read books on personal finance, follow expert blogs, and stay on top of financial news. Continuing education will help you make smarter decisions and be prepared for any changes in the economic landscape. 2. Create a budget and stick to it. The basis of financial freedom is having control over your income and expenses. A proper budget allows you to allocate part of your money to savings, investment, and debt repayment, while ensuring that you cover your essential needs. The discipline to stick to your budget is key to ensuring that your resources are allocated to the right areas. Tip: review your budget regularly to make sure it aligns with your financial goals. If you have changes in your income or expenses, adjust your budget accordingly. 3. Save and invest regularly. Saving is not enough. The key is to grow your money through investments. Saving provides you with a solid financial foundation, but investments allow you to generate passive income and grow your wealth. Make sure you save a portion of your income each month and allocate a portion of these savings to investments that can offer you long-term returns. Tip: start investing as soon as possible, even if you can only invest small amounts. As your savings grow, you can expand your investments to earn higher returns. 4. Eliminating debt. Debt can be a significant obstacle on the road to financial freedom. Every debt payment you make is an expense that could be used to save and invest. That's why it's important to have a clear strategy for paying off your debts as quickly as possible, starting with the debts with the highest interest rates. Tip: consider the snowball strategy for paying off debts, which consists of paying off the smallest debts first and then tackling the largest ones. This will give you a boost of motivation as you pay off your debts. 5. Diversification of income. Don't put all your eggs in one basket. One of the best ways to ensure your financial freedom is to diversify your sources of income. This can include having a main job, but also generating passive income through investments, your own business, or side jobs. Tip: explore new opportunities to generate additional income, such as entrepreneurship, real estate investments, or even passive income through the internet, such as selling digital products or creating content on streaming platforms. 6. Long-term mindset. Financial freedom is not achieved overnight. The key is to have a long-term vision, to be patient, and to make financial decisions based on your future goals. Don't be tempted by instant gratification or the fear of temporary difficulties. The road to financial freedom requires patience and perseverance. Tip: always keep your long-term goals in mind and don't be tempted by impulse buying. Remember that the decisions you make today will influence your financial future. 7. Protect your assets with adequate insurance. It is essential to protect your assets and your future with adequate insurance, such as health, life, auto, and property insurance. Insurance provides you with a safety net in case of emergencies, allowing you to avoid significant losses that could affect your financial stability. Tip: review and adjust your insurance regularly to make sure you are adequately covered. Make sure the coverage is sufficient to protect your assets and your well-being. Final thoughts. Achieving financial freedom is a journey that requires discipline, education, and a long-term mindset. By making informed decisions, managing your money wisely, and being consistent in your efforts, you can create a solid foundation for a secure and prosperous financial future. It's not just about accumulating wealth, but about achieving financial independence and living on your own terms. This book has been designed to help you understand the key principles of financial education and how to apply them in your daily life. By putting these principles into practice, you'll be on the right path to achieving the financial stability and freedom you desire. Congratulations on getting this far. Remember that the journey to financial freedom is a continuous process. Keep learning, keep growing, and keep making decisions that bring you closer to your goal of having a future free of financial worries. We invite you to subscribe to our Audio Mentors channel for more valuable content on financial education and other topics that will help you improve your life and your finances.